Good morning, everyone. Hi, I'm Praveen Sharma, and I welcome you all in our today's session on this series of webinars, which we've been doing for quite some time. This webinar will be on financial reporting exam preparation, and our speaker, Sandip Khetan, would be walking you through and giving you a quick coverage so that you are better prepared for the exams. A quick introduction to our speaker. So Sandip Khetan is a national leader and for accounting advisory services in India, FAS, we call it. And Sandip has over 20 plus years of experience in advisory and consulting industry. He graduated in commerce from University of Calcutta and cleared his CA in the year 2000 with the All India rank 14. He has also done US CPA and company secretary courses and is a proud alumni of IIM Ahmedabad. Sandeep was also part of the Indian Accounting Standards Implementation Committee of ICI and has been part of several groups formed for issuance of implementation guidance under Indian accounting standards. And Sandeep regularly engages with standard setters and regulatory bodies in India to help grow the accounting profession. So I welcome you, Sandeep. Hi, Sandeep. Hello.
Hi, Raveen. Thank you. We're just going to take a minute.
Sure.
I think Nitin is just setting it up. Good morning, everyone.
So I'll just log off and over to you, Sandeep.
Thank you. Okay, good morning, everyone. So I think today is a marathon session for all of you, right? So we've spent a good amount of time to put together the content for today's session. Yes, I have my colleague here. He wants to do something.
I mean, now it is coming on full screen?
Yes, yes. It is perfect. Thank you, Nitin.
Thank you. Awesome. Thank you. Finally. All right. Okay, once again, good morning to all of you. As you can see, the slide we have on the screen. So what we've done is that we spent a good amount of time to look at the pattern, the questions, the type of questions which comes through over last 4 terms, right? And that's what the team has tried to summarize it in terms of what are the areas where do we see the questions coming in, and what I will do over next 3 hours, right? And look forward for all of your participation, is to help you understand, how all of these accounting standards are going to get applied, right? From a practice perspective, when you, in a way, try to visualize a particular accounting standard, why it's been written, what's the area coverage, etc., what we're trying to do, from an accounting standard perspective. So what you see on the slide, we have tried to group all accounting standard into these 7 categories, which is assets, liabilities, revenues and income tax, presentation and disclosure, financial instrument, group financial statements, and some other miscellaneous areas, which principally is like employee benefits and foreign exchange. So I will aim to, in a way, take you through with all of this, at a high level, as I said. And of course, happy to take questions as we progress. But we will try to keep the momentum in a way going for you to appreciate and understand some of these accounting standard as you in a way visualize. The whole idea is that when you are going through your revision sessions, you should be able to in a way visualize what we've been talking today, and that will help you possibly recollect many of these principles, and then that will eventually help you to write your perspective. So when you look at the assets, liabilities, revenue, so out of assets, we know in last 4 terms in total of 85 marks, which is what in a way is been covered from an asset perspective. Right, total of 85 marks. Similarly, on liabilities, we have 4 marks, though the Ind-AS 116 is a new topic, right? Ind-AS 116 on leases is a new topic yet to be tested. So possibly there's going to be something in November 2020, hoping that the exams will still happen in November of 2020. Revenues and income taxes, important area where we have 26 marks. Presentation and disclosure, 68 marks. Largely the questions do come from accounting policy changes, errors and estimates and things like that. And we will talk about accounting nuances. Financial instrument is a very, very important topic. And a lot of question, but principally the questions comes in terms of compounding of compound financial instrument, and we will talk about the principles around that. And then the group financial statements, in a way, questions do come in from consolidation perspective, business combination perspective, determination of goodwill perspective, so on and so forth. And then some bit of thing what we see, some questions do come on employee stock options and things like that. So all in all, I think the out of 40 accounting standards, what we have, if you look at principally the group accounting group consolidated financial statement, which is around business combination, consolidated financial statement, equity methods, separate financial statement, or joint venture. That in a way is a big component. And then you have financial instrument, another big component. So if you cover these two, and then you have this in a way assets, and that assets also largely on the property, plant and equipment, you get a good coverage of the syllabus, right? Good coverage of the syllabus, which assures you 40 marks. And then of course go beyond that, keep on doing well, and do of course target to get 100, nothing less than that. So talking about the assets, right? When you now look at assets, the category, out of all of these topics, inventories, property, plant and equipment, government grant, borrowing cost, intangible asset, impairment of assets, and non-current asset held for sale. So these are the key topics within the asset section, which have been tested from an examination perspective. But when you see it, it is property, plant and equipment where we see too many questions coming in. Almost very, very regularly, I think there is a set of questions coming in from property, plant and equipment. And then the non-current asset held for sale. And then one question which was there in November 2018 on 15 marks for, on impairment, so on and so forth. So some of these topics are important. There was a question on borrowing cost, and we will try and understand, talk through all of these one by one, right? I'm going to take you through in summary what some of these all concepts do mean, do talk about, from that perspective. And happy to, in a way, have your feedback post the session, about your experience, about the learning and what more. So we've spent, again, a lot of time in trying to put together the whole content in a very, very concise format, right? So that you can visualize the entire accounting standard in a couple of slides. I think that's what is the whole idea here, right? Now, when you look at the inventory standard, which is Ind-AS 2, right? Inventory standard, the questions have come around overhead allocations, right? Overhead allocations. So what is an inventory? Inventory is something which is, which is held by an enterprise, which is to be, used for the purpose of a sale in the ordinary course of business, in the process of production for such sale, which is like work in progress, right? Which is still in the manufacturing process, or it could be in the form of raw materials. So inventories are of two types, one which is like a finished goods, the other one is a work in progress, the third one is like a raw material. So finished goods, semi-finished goods, or raw material, from that perspective. In which industries we see inventory? Inventories is largely there in manufacturing industry, right? In some services industry, there is some inventory, but which is like the things which they need to use for the purpose of doing their services, but very far and few from that perspective. It's largely the manufacturing industry where we see inventory. How do you value inventory, right? The principles of valuation of inventory is cost or market price, whichever is lower. Cost or market price, whichever is lower. So that's the fundamental principles of valuation of inventory. Now, how do you determine cost and how do you determine market price? That is in a way becomes important element here, and that's where we're going to talk about how do you determine cost, right? And that's where the cost is, and that's where the question is that what all goes as part of cost, right? When you look at cost, what all goes is a purchase cost, conversion cost, direct production cost, and allocation of fixed and variable production overhead. That is what goes as part of your cost. And then what all you don't include is your abnormal wastage, storage cost, administrative overheads, and your selling cost. These are not allowed to be loaded as part of your inventory cost. So what is direct cost? Try and understand this is the direct cost to purchase of raw material, processing cost, and then factory overheads, all of that allowed to get loaded, right, as part of the inventory cost in a suitable manner. What is not allowed, if let's say there's a shutdown of the plant, can you continue to load the shutdown cost to the inventory? If it is an abnormal shutdown, answer to that is no, right? Abnormal wastage is not allowed, storage cost is not allowed, administrative overhead is not allowed, selling cost is not allowed, right? So that is what is considered as part of your cost, right? What all goes as part of cost. And then what is the selling price, right? Selling price is the estimated selling price in the ordinary course of business less the estimated cost of completion and estimated cost necessary to make the sale, right? So what are we trying to say here is NRV, net realizable value, is, let's say, is the price which you expect to realize if you were to sell it to an external party minus the cost of selling, minus the direct cost of selling, not the advertisement. If I need to do an advertisement, that's anyway a different cost. So what is an estimated cost necessary to make the sale? All of that is excluded while determining while is factored in while determining the net realizable value. And we're going to talk about a lot more on the fair value. Fair value when we will cover the Ind-AS 113, which is defined as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. And we're going to talk about that, which is often called as exit price, exit price. So what are the techniques now of inventory valuation? You can do first in, first out, right? First in, first out, which is called as FIFO method. You can do a specific identification method, or you can also do weighted average method. These are the methods we commonly see while doing inventory valuation. LIFO as a method of inventory valuation is generally not allowed. Last in, first out is not allowed. First in, so that means whatever you manufacture today, that is supposed to be sold first, right? And then next in line, next in line, next in line kind of stuff. First in, first out. That is what we see most commonly, or we see weighted average cost. These are the two methods of inventory valuation. Now, if you're a retail industry, right, like Reliance Retail or like Future Retail, so on and so forth, how do you value inventory? You're a large company, you have a large number of your stock units, and it's very difficult for you to actually figure out cost, right? And then what you do, it is something called retail method. So you have a market price of that, you know what margin you operate, you simply do a markdown, right? So if let's say the market price is 100 and you believe that I operated a 40% margin, gross margin, then 40% is what you take down, then 60 is what at you value inventory. You do rationalization test to ensure that 60 in a way represent your cost of purchase, right? And from a purchase cost perspective, what all goes in your purchase, conversion, direct production, all of that is what forms part of your purchase cost. So now we've understood inventory, right? What is inventory? Is something which is what you either you purchase or you produce, right? Why you do purchase? Because you want to resell, right? You want to resell. That's a manufacturing industry phenomena largely. So you got to purchase, and then how do you value inventory? Cost or market price, whichever is lower. Now, once you have recorded initial recognition, now we get to the subsequent measurement, right? Subsequent measurement is again cost or market price, whichever is lower. That's the continuous process. If you have recorded an impairment loss in one period, because let's say your cost was 100, okay, whereas your cost was 100 and your market price for that inventory or NRV, so to say, was 80, right? And then as a result of which 20 rupee of loss is what you had to record in your financial statement. Now you get to a subsequent period and now the NRV has gone up to 110, right? Then you're allowed to write back the loss, and assuming this inventory is still in your balance sheet, you're allowed to write back the loss which has been recorded, from that perspective. So moving forward, you have two types of overheads, which is a fixed production overhead and a variable production overhead from a conversion cost perspective. And when you think about a fixed production overhead, that is where you look at the capacity of the plant. What's the capacity of the plant if it were to operate an optimal capacity? And then you determine the overhead absorption cost, right, per unit of inventory, from that perspective, and that is what gets added. For example, if you assume that if you determine that the total capacity of this plant is 1,000 unit a month, right, and your fixed production overhead is 10,000, that means what, 10 rupees per unit is what is supposed to be allocated. Now, if you've only produced 800 units in that month, instead of producing 1,000 units, you can only allocate 8,000. That means 2,000 is to be charged off to P&L as a period cost, and only 8,000 going to get allocated in a way to inventory. And that's the thing around fixed production overhead. Similarly, on variable production overhead, and this is supposed to vary with reference to the units of production, and hence till the time it is directly related to the inventory production, it is incremental to the value of the inventory. You will keep on adding it. We see some examples where when you're trying to make a product, it results into two products coming out as an output, right? Which is what we call as joint product. Many times you see there's a main product and there is a byproduct, and then you apply an appropriate methodology in a way to allocate the cost, right? To allocate the cost or all these overheads to each of the components which are getting produced in a reasonable manner, right? In a reasonable manner. If the byproduct is immaterial, then you try and value it based on market price. If it is relevant material in a way, then you try and do in proportionate allocation, either based on their market price, from that perspective, and you try and absorb all your overheads in an equitable manner, because that's the initial recognition. Subsequent recognition again is cost of market price, whichever is lower. And if you've recorded an impairment loss, you are allowed to reverse that impairment loss in the future period if there is an improvement in the market price in a way from that perspective. So that is what we had on inventory, right? Inventory is not a big topic from an exam perspective. You would simply think through that method of inventory valuation is cost or market, how do you value inventory, cost of market price, whichever is lower. You look at a FIFO method or a weighted average cost method. What all goes into your cost is your purchase cost, direct overheads, and your other allocated overheads, which gets allocated depending upon type of overhead. What you don't allocate is your abnormal cost. Anything which is abnormal, selling cost, storage cost, is that what you don't allocate. In few examples, we also see interest costs getting allocated to inventory as well. Okay, moving forward now to talk about fixed asset. Now, this is an important topic, right? So what are your fixed assets? These are called tangible assets, right? And a simple example of that is land, building, land, building, furniture, fixtures, plant and machinery, right? All of that is an example of your property, plant and equipment. How do you do accounting for property, plant and equipment? So from an examination perspective, we see there are questions being asked on cost and revaluation model, or there are questions being asked around capitalization and depreciation, from that perspective. So how do you do accounts for accounting for property, plant and equipment? So what are your tangible assets? What are the purpose for which you're using it? You can use it in the production or supply of goods or services. You can use it in a way for administrative purpose, or you also use it for giving it on rent in a way to other. If you're using it for giving on rent to other, you got to also possibly think through and apply Ind-AS 116 in relation to leasing. And we will talk about that in a little bit of detail as well. So property, plant and equipment or tangible asset, right? It is like land, building, furniture, fixture, plant and machinery used in the production process or for rentals or for the purpose of administrative purpose, right? What is scoped out from the perspective of this standard? Anything which is as held for sale, biological assets or exploration and evaluation assets or mineral rights. So assets for which we have a specific accounting standard which are covered in different, like Ind-AS 106 is for exploration and evaluation asset. We have Ind-AS 41 agriculture assets in a way from that perspective. PPE classified as held for sale is accounted for under Ind-AS 105. So anything which is accounted more specifically in any other standard, then they are not covered here. Otherwise, in a way, they are covered here. So what all goes into how do you do accounting for property, plant, and equipment. The initial accounting for property, plant, and equipment is at cost, right? Now, what all goes into my cost? Again, when I look at my cost, it is purchased cost, directly attributable cost, and present value of dismantling charges. So, for example, you've taken a land on lease and you are doing a building construction of a building, and after 30 years you got to return this land to the lessor, and the condition as part of the return of the land is say that you have to dismantle this building, bring this land to its original condition and situation. That is the dismantling cost, and that also you are supposed to allocate. You are supposed to determine how much cost I'm going to incur after 30 years, discount to the present value, and load it to the carrying value of the property, plant, and equipment. What is not allowed to be included is your opening a new facility cost, your training cost, advertisement and promotional activities, and your administration and general overhead. These are the type of costs which are not allowed to be identified or loaded as part of your property, plant, and equipment. So if you're buying a land, for example, if you're buying a building, whatever is the transaction price plus your stamp fee, brokerage fee, etc., all of that you can load as part of your purchase cost. The challenge comes when you're actually building an asset, right? You're building an asset by yourself, and that's where what all will go: your purchase of, again, your raw material, your labor cost, your construction cost, then some of your direct overheads, interest cost also in some situation is allowed to be in a way capitalized, and we will talk about Ind-AS 23 on borrowing cost, right? So how do you account for your property, plant, and equipment? So initial accounting, as I said, cost model. Subsequent accounting is that you can do a cost model or a revaluation model. Both are in a way acceptable method of accounting. Now, rarely in practice we see revaluation model as an accounting practice being followed by companies. So large number of companies, if I look at 1,000 companies, 999 of them will do cost model. There is hardly a company which may do fair value accounting, but the accounting standard do permit. If you do revaluation model, then you have to apply this on a consistent basis, right? The another important concept which is out there in the standard, which you need to remember, is the component accounting. A simple example of a component accounting is an aircraft. Let's say if I buy an aircraft, and let's say the life of the aircraft is 20 years, but I have to actually spend some money for that aircraft for periodic maintenance, right? That's a mandatory requirement for me to continue to operate that aircraft, for example, after 3 years, after 6 years, after 9 years, which is like overhauling cost, right? Now that overhauling cost is nothing but like a component that you have to identify and treat it like a component from that perspective. We also see components in several other examples. For example, let's say a building, right? When you have a building, you may also have, let's say, the whole air conditioning system which you installed as part of the building construction itself. Now the building may have a life of 50 years, whereas the air conditioning unit which you have installed, that may have a life of 20 years. The lifts what you have in the building may have a different life, so on and so forth. So if they are material and the life is also materially different, then you may have to treat them differently, though they may get disclosed together, but the depreciation is going to be different in a way from that perspective. The recognition, from a recognition perspective, you've got to make sure the cost measurements are reliable, right? And the economic benefit is going to flow to the entity from that perspective. So again, what is a property, plant, and equipment? Something which is to be used in the production process or for administrative purpose or for giving on rental to others. What all goes as part of my cost? My purchase cost, my directly attributable cost, my other overheads, including the restoration cost, right? What you're not allowed to include is your opening a new facility, advertisement cost, training cost. Those are indirect costs, not allowed to be loaded, right? You got to also, we talked about the whole component accounting. That's an important concept. Remember that you could be tested on that. And then the two models of accounting, you can do a cost model or a fair value model or a revaluation model, right? Now, when you do a fair value model, the change in fair value, right? When you're doing a revaluation model, the change in fair value, that doesn't go to profit and loss account. The change in fair value goes to other comprehensive income, a statement of changes in equity. It is a component of that, right? Let's say my cost of that asset was 100. I did a fair value of that, and when I did the fair value, it has now gone up to 120. The 20 increase in fair value will not go to profit and loss account, but it will go to other comprehensive income. Please remember that it goes to other comprehensive income. Now let's say in the next period you again done a fair valuation, and it has now gone up to, from 120 it has actually come to 80, right? Now if it has come to 80, so we did once, so I was at 100, I moved to 120 in one period, and then I moved to 80, right? Now when I move to 120, it goes to OCI, the 20 goes to OCI. But when I move to 80, right, the 20 which previously was gone to OCI, I'm going to recoup this 20 from the OCI, but the balance 20, right, the balance 20 will be charged to profit and loss account. So if it is in excess of your carrying, if there's a loss which is over and above your cost, right, that loss is immediately charged to profit and loss account. If there is a gain over and above your cost, that gain goes to your other comprehensive income. If in the subsequent revaluation, subject to the gain which you have previously recognized in OCI, you're going to recoup any subsequent downward valuation. Once you have recouped everything what is there in OCI, any more devaluation, that will go to profit and loss account. That will go to profit and loss account. Now, on an ongoing basis, how will you then do accounting for property, plant, and equipment? You will have to do depreciation and amortization. Depreciation, why do we need to depreciate? We need to depreciate because of wear and tear. We need to depreciate because of technological obsolescence. We have to depreciate because everything has a limited life other than land, right? So land, we don't depreciate. We will only depreciate land if it is a leasehold land. That means my right to use that land will be taken away from me after certain specified period, say 50 years. So whatever I paid to acquire that land, for me having the right for 50 years, I'm going to depreciate or amortize it over that 50 year. Otherwise, land I don't depreciate. Other than land, every other type of tangible fixed asset is required to be depreciated. Depreciated over what period? Over its useful life minus the residual value. So you need to remember the residual value. So if let's say the cost of purchase of asset is 1,000, my residual value is 1,000. So how much I need to depreciate? 9,000. Over what period? Over its useful life, right? Then you have to determine the useful life from an organization perspective. It could be 5 year, 10 year, 15 year, 20 year, 30 year, 40 year, depending upon what you believe is going to be a useful life. It's an area of judgment. Though we have Schedule 2, which do provide us some guidance in terms of some useful life indicators, but they are just indicators. We continuously see diversity in practice between what is there in the Schedule 2 versus what has been applied by the companies, but you've got to apply it consistently. Now, what are the methods of depreciation? Most commonly, we see straight line method of depreciation. You can follow a diminishing balance method. This is what you follow under income tax law, WDV, right? Or you can follow a sum of unit method. Sum of unit method, very rarely again we see where, I think the wear and tear is actually linked to the units of production. Otherwise, it's very difficult to find a direct correlation between unit of production and actual wear and tear of the plant and machinery, right? So from that perspective, so how do you do the depreciation methods? Are your straight line method or a WDV method or a sum of unit production? The important point is the standard do not say that this is the method you need to follow. You need to follow a method which appropriately represents the usage of that asset, from that perspective. And then you got to de-recognize. We have to de-recognize when you're going to dispose. When you're going to dispose or you're going to discard, right? Either I'm going to discard this or I'm going to dispose this. That means there is a sale, then you're going to de-recognize that fixed asset or you're going to discard it. That means you're no longer going to use this asset in the normal, either for the purpose of production or for the purpose of rental or for an administrative purpose. Then you got to discard this in a way from your property, plant and equipment. So that's what we had on property, plant and equipment. So important thing is the accounting models are cost or evaluation, And if you follow revaluation, you got to follow it on a consistent basis. And then you got to deal with the depreciation method, which is a straight line. Remember, when you think about depreciation, you have to always remember residual amount, right? And depreciate over its useful life subject to the residual value. And you also think through the restoration cost, which is what is also being called as decommissioning cost, right? So you have set up a factory, you have set up a plant and machinery. The condition suggests that I got to remove, when I going to remove this plant, I got to restore it to original condition. That's the cost of decommissioning, restoration, etc. That is also required to be factored in today and capitalized and then depreciated. And there's a whole lot of complexity to say that subsequent change in that estimate. How do you deal with that, from that perspective? So all of that is what we need to think through, right? As you look at the accounting principles on accounting for property, plant, and equipment. Moving forward to talk to you about accounting principles around government grant, right? Government grant. So government around the world are kind of providing grants, right, to deal with COVID-19, the pandemic. A lot of government have cut checks and sent out. The American government, the United States have written multiple, billions of dollars, right? Trillions of dollars, in fact, in terms of providing aids to people to support them, right? So if you, there are two types of, in a way, government grant, right? So what's a government grant, so to say? So let's say you want to set up a, let's say that, a lot of you may have read about this whole PLI scheme, production linked incentive schemes, right? That's nothing but a form of government grant. Many times you see UP mills in sugar mills in UP, right? They do receive some subsidy by way of interest waiver. That's a form of government grant, for example, right? Many times we hear that if you were to set up a factory in a remote area, you will be exempted from sales tax obligation or from this obligation, from that obligation. That's a government grant from that perspective. So it is other than income tax related benefits, right? So whatever you get from an income tax thing, that is what is to be dealt with under Ind-AS 12, not to be dealt with under Ind-AS 20. But then many other times, so many times, let's say if you're doing export, you get what we call is a SEIS scheme, Service Export Incentive Scheme, so to say. So you're going to receive export scripts. You receive scripts which you can sell, and then those buyers can offset that scripts as a tax obligation against their tax obligation, so on and so forth. So there are several types in which government incentivizes industry, right? From that perspective. So the question which you need to think through is that what's the recognition? How do you deal with what are the methods of accounting of government grant in relation to monetary grant and non-monetary grant? Monetary grant, government may cut a check and give the money to you. Government may say, I'm giving this land to you, right? Or I want to give this plant and machinery. Let's say, for example, right, in Delhi, we're all struggling with pollution, right? And then government is saying, I'm going to subsidize the purchase of farm equipment to the extent of 50% of the cost. Now, that's also a form of government grant, right, which the government is giving. So the question is, how do I do accounting for all of this, right? So it's an assistance by the government in the form of transfer of resources to an entity in return for past or future compliance with certain condition, right? So when you recognize this is when you go into either when I have received the grant, right? What's the recognition criteria? Either I have received the grant or I'm going to fulfill, I'm in a position to fulfill all conditions in relation to the grant on an ongoing basis, and then you're going to determine the method of attribution, in your profit and loss account, from that perspective, and it will be received. There is no uncertainty in your mind that this will be received. And again, the test and thresholds are like probable. It is probable that you will be able to fulfill all the conditions, right? Or like reasonable assurance, right? Reasonable assurance. So if it is related to assets, you recognize in profit and loss account over the period matching with depreciation expense of those assets. For example, the government said that I'm going to give you 10,000 rupees for setting up plant and machinery in this backward area. Very good. So I've set up the plant and machinery in this backward area. I've received 10,000 rupees, right? Now this 10,000 rupees, should it go to P&L immediately or it should go over the period of time? So if it is related to an asset, it is now this plant and machinery I need to depreciate over its useful life, say 10 years minus the residual amount. Remember the residual amount. So let's say the plant and machinery cost was 1 lakh rupees, the residual amount is 10,000 rupees. So 90,000 rupees I need to depreciate over a 10-year period. I have received these 10,000 rupees of government grant. So this 1,000 rupees will come into my P&L every year. So 10,000 which I have received, even though I may have received in year one, that 10,000 rupees will get recorded as a deferred income or a deferred government grant, so to say. And out of that 10,000 every year, I'm going to record 1,000 in my P&L. I'm going to keep on releasing it, right? Now, if it is related to an income item, for example, if you were to, if you were to do so much of employment, right, I'm going to give you so much of grant. If you were to sell so much, like production linked incentive scheme, to produce so much, I'm going to give you so much of grant. So you got to figure out the correlation as to what is the purpose for which the government is giving the grant, and then you got to determine the appropriate accounting, for such grant. If it is related to a non-monetary asset, right? Let's say, as I said, government has given you the land itself. You have an accounting policy choice, either to record that at fair value or record that at nominal cost, right? Both of that in a way are possible. Now, if there is a loan from the government, like the sugar industry example I talked about, right? Again, let's say they've said that I'm just going to cut a check and you good luck to you, provided you fulfill these conditions. So if you already fulfilled the condition, you can record that loan as a credit in your P&L, or if you're receiving the interest subsidy, you got to again record that interest subsidy as a credit in your P&L and record the interest cost on a normal basis. So all of that is what you need to look at, because the initial recognition is always at fair value, right? So a very simple example, if I were to give you this, let's say a sugar mill where the government says, I'm going to give you 100 crores, right? I'm going to give you 100 crores, right? Now 100 crores for a 2-year period, for example, right? 2-year period. Now, if they're giving me 100 crores for a 2-year period, if I were to borrow this money for a 2-year period from a lender, that guy is going to charge me 10% interest per annum. Now, government says, I'm giving you 100 crore for a 2-year period. I'm going to charge you only 2% interest, right? That means there is an 8% saving of interest for me. There's an 8% saving of interest for me on this 100 crore which I have received. So what I need to do, this 100 crore, I need to discount it to the present value, for 2 years at the rate of 8% in a way, right? And then you're going to possibly say, the present value of this loan is actually 86, right? Or maybe 87, for example. So 13 rupees benefit is what you have is a government grant, right? Which is then you got to determine that over what period you need to record, whether you need to record it immediately, provided you fulfill all the conditions, right? And then you may want to record it immediately. If you've not fulfilled the conditions are yet to be fulfilled, then you're going to record it by matching the cost, which I'm going to incur. But if you're fulfilled, you're paid out to all your farmers, you may want to record this immediately. And then you're going to record your interest cost at the rate of 10%, which will include a notional cost, of 8% and the 2% of actual cost. So end of the day, your loan value will come back to 100, which I need to then pay back to the government of, let's say, India, after 2 years, from that perspective. So if there are situations, right, there are situations that there is a grant which has been received, which is without condition, for example, right? If it is received without condition, then I'm going to record this in my P&L immediately. If it is received with condition, I need to again evaluate those conditions and make sure that have I fulfilled those conditions. And if the answer to that is yes, then I'm going to record that. If the answer to that is no, then I'm going to keep on recording it as I'm fulfilling those conditions, and I have to be reasonably confident. Now, let's say reasonable assurance, right? Now, let's say that I was reasonably assured that I will be able to fulfill the condition, and hence I was recording that as a gain in the P&L or the income in the P&L. Now I realize that I'm not able to fulfill the condition. Okay, then what happens? You go to reverse the gain by recording a loss in the P&L, right? It was grant related to asset, right? And you had actually adjusted this from the cost of purchase of the asset. In that case, you are allowed to load it back to the asset cost itself. from that perspective, subject to your depreciation adjustments and things like that. So there are accounting nuances which you need to be careful about, and similarly, which is the same thing I was talking about, the repayment of government grant. If it is related to asset, you can go back and adjust it to the asset itself, subject to adjustment on account of depreciation. If it is related to income, you already recorded it, then you got to again record that as a loss in the P&L in that period. From that perspective, if it is a non-monetary government grant, you have an accounting policy choice that do I record this at fair value or I record this at nominal value, in a way from that perspective. So all in all, right, when you think through government grant, first visualize what are the type of grants which we see commonly in our scheme of things. Okay, these are the type of grants we see. Now, are they related to asset? Are they related to income? Let's say a lot of government grant we're seeing again in current times is for doing R&D for COVID vaccine, right? Now the government is giving you a grant for doing R&D for COVID vaccines. So let's say they may give you a grant 1,000 rupees. You are a credible institution, not 1,000 rupees, but let's say 10 crores, for example, right? 1,000 rupees, you can't do any vaccine. So 10 crores for doing some vaccine research, right? And then say you're a credible institute, I'm going to give you this 10 crore to spend over next 24 months, right, on this R&D. That's the purpose, that's the ask, and you may have to provide expense statement to the government. Look, this is how I spent your money. So as you keep incurring costs, you keep on releasing this 10 crore to your P&L, in an appropriate manner. Or they may say that this 10 crore is subject to successful production of a COVID vaccine. That means this 10 crore you can't record as an income because you haven't yet demonstrated that you will be successful. That means this 10 crore will lie in a deferred grant in your balance sheet. You may have received the cash, but it is not coming to your P&L. It will only come to your P&L when you want to fulfill the conditions, or there's a reasonable assurance that you will be able to fulfill the condition in a way from that perspective. So think through government grant, and then how do you present them? You can present them as a separate line item like an other income, or also in relation to the reduction of that particular cost for which the government grant has been given, in a way from that perspective. There are some accounting policy choices in a way from a government grant perspective, and you need to apply them again carefully, and whatever you choose, you got to apply them on a consistent basis on a go forward from a financial statement perspective. So I hope that gives you a good perspective on accounting for government grant. Let's move forward and talk about borrowing cost, right? Accounting for borrowing cost. So when we think about a borrowing cost, now that's a very, very important thing I wanted to talk to you about. So a very important concept, which I often see missing, in people's minds. So let me give you an example. Let's say you are doing a construction of a plant, right? And that plant is going to take, let's say, 2 years for you to build. And let's say the cost of the construction of the plant is 1,000 crores, right? And you borrowed 500 crores to do the construction of the plant, and 500 crores is your own equity. Now, 2 years are over, the plant's been constructed, you borrowed money at the rate of 10%. The simple answer is that 10% money, what you borrowed, 500 crore, you want to capitalize as part of cost of construction of the plant. Now the plant construction is over, right? Now, once the construction is over, you're no longer allowed to do the capitalization of the interest cost because there is no qualifying asset, so to say. However, let's assume that you started another plant construction, plant B, okay? Now, if you started doing plant B and at this time you decided not to borrow any more money, the question often comes is that the interest cost which I continue to incur, for the money which I borrowed for the construction of plant A, can I continue to capitalize that interest cost? The answer to that is yes. You are actually required and allowed to capitalize the interest cost which you will continue to incur on the borrowing which you've done for construction of plant A, which is now finished. But now that in a way the loan is continued to be outstanding and you have started another construction of a plant which is plant B, and hence you should start the interest capitalization. Now, why is that? Okay, now let me give you a different way of explaining the same thing. So let's say this same plant, this money was outstanding 500 crore. You decided to repay as soon as the construction was over. You repaid the plant, you repaid the loan, right? 500 crore. Now you started another plant, plant B, and you borrowed new money of 500 crores. Okay. Now if you think through all of that, there's a plant A, there was a plant B, 500 crore which I borrowed here, and then I repaid on construction. Then for B, I borrowed another 500 crore. Okay. So now you will say, yeah, there is no confusion here. You please capitalize because this money is being borrowed for plant B. That's the whole point here, right? What is the point here is that the money is fungible. The money in your left pocket or right pocket is all the money. Is end of the day is cash, right? There is no distinction, from that perspective. The only distinction what Ind-AS 23 in a way makes it here is that whether it's a specific borrowing or whether it is a general borrowing, right? If it is a specific borrowing or it is a general borrowing. Okay. If it is a specific borrowing, then that interest cost gets capitalized against that specific borrowing anyways, for that specific construction. If it is a general borrowing, then you got to determine the capitalization rate. Okay. And that's a question. There was a question which came on the exam on determination of the capitalization rate. So now let me give you the whole standard, in a perspective, so to say. Okay. So what is this whole standard all about? So there is a qualifying asset, right? So what is a qualifying asset? On the right hand side of your balance sheet, there is a qualifying asset. What is a qualifying asset? Qualifying asset is an asset which takes substantial amount of time for you to do the construction. Okay. Now, what is this substantial amount of time? That is not defined in the standard. Ordinarily is something which takes more than 12 months. It is presumed to be that it is taking something which is 12 months, but 12 months is, let's say, a guidance. 12 months is a guidance, but if it takes 8 months or takes 11 months, can I capitalize? It's an area of judgment. Possibly yes. Okay. Possibly yes. So one is that there has to be a qualifying asset. That's one criteria. The second criteria is that there has to be an interest cost which is there on the left hand side of the balance sheet. In a way, there has to be a loan, there has to be a borrowing, or there has to be any other item in your balance sheet on which you are incurring cost. For example, if there's a lease liability and you are incurring interest cost on that lease liability, right? There is an income tax liability and you got to pay interest on that income tax liability. So anything which is classified as an interest cost and there is a qualifying asset, then you are supposed to look at the matching of the two and figure out how much interest I need to capitalize. This is a mandatory requirement. This is not an accounting policy choice, right? So and on what you capitalize on qualifying asset, which is like a tangible asset, or you may be allowed to capitalize in relation to inventories, right? Inventories, again, which take substantial period of time, which are not repetitive in nature, in a way, so to say. That is where you are allowed to capitalize on inventories as well. Right. So you got to identify what is my qualifying asset and what's my interest cost. So what are my borrowing cost, which is your interest expense, my finance charges, my exchange differences on foreign currency borrowing as an adjustment to interest cost. Now, what is this foreign exchange borrowing? It's a very simple example. So to say, let me give you an example. So you borrow money, right? You borrowed money, say $100, right? Now, if you borrow money in Indian currency, this $100 is actually 7,400 rupees based on, let's say, yesterday's exchange rate. So now on this money, the Indian bank will say that I'm going to charge you interest of, let's say, 9%. Okay. Now, 9% is what our Indian banks are going to charge. But when I go to an overseas bank, say, Standard Chartered Bank or a Deutsche Bank or an HSBC, and I want to borrow money in US dollar, or I can do this with the Indian banks also, but say I want to borrow money in US dollars, then they will be happy to offer me, provided my credit rating and credit risk criteria are satisfied. They may say, I'm going to give you this loan at the rate of 4%, right? 4%. So when I want to borrow money in Indian rupees, it cost me more. When I want to borrow money in a foreign currency, it cost me less. And why is that? It's a general principle of economics, is the interest rate parity concept. In Indian economic environment, the deposit rates are higher. So if you were to deposit money with the bank, you may get 6%, 7%, 8%, 5%. So if you were to borrow money, similarly, the bank charges spread on that, and lend money. Similarly, if you were to go in overseas jurisdiction, if you were to deposit money, you only get 1%, half a percent. Sometimes you may have to pay money actually, right? In Japan, now you have to pay money to keep money with the bank. So they don't pay you any interest, right? So that's the interest rate arbitrage opportunity is what we have, which is a concept of interest rate parity, which is largely again explained with the exchange rate differential parity. So what happens? There's an exchange rate risk which you are taking by borrowing money in a foreign currency. If you're taking an exchange rate risk, so to the extent of your interest which has been saved, right, which you may lose if the Indian rupee were to depreciate against that currency, let's say, which in this example is 5%. So that 5 up to the foreign currency loss to the extent of 5%, if you have a qualifying asset, you are actually allowed to capitalize that as well. In fact, required to capitalize that interest cost as well, right? So again, when you think about a borrowing cost, you got to think about a qualifying asset, you think about a loan, then you got to think about a loan, you got to assess, do I have a specific borrowing or do I have a general borrowing, right? Do I have a specific, if this is specific borrowing, that percentage is capitalized, right? If I have a general borrowing, then I need to look at different types of borrowings which I have. So I may have a working capital loan. I may have other loans which are sitting in my balance sheet. I may have a corporate loan. I may have, anything by whatever name called, right? So then you got to determine your cost of capital, your cost of borrowed capital. Let's say you borrowed a working capital loan at 10%, you borrowed a corporate loan at 12%, you borrowed, a loan against plant A, which is already been complete, that was at 8%. So 8%, 10%, 12%, there are three different types of loan. Now you got to determine your weighted average cost of borrowing. Let's say that number comes to 10%. Now that is your capitalization rate, which you need to apply, for your construction of property, plant and equipment, wherever you've not been able to exhaust the amount of cost of qualifying asset from the specific borrowing. So I hope this is in a way clear to you. So we've talked about the recognition, borrowing cost directly attributable to acquisition, construction. All of that is what you capitalize. What are the scope exclusions? Biological assets, something which is recorded at fair value. There's scope exclusion. Inventories produced in large quantities on a repetitive basis, you are not allowed to capitalize. What all part of your borrowing cost, your interest cost, finance cost, exchange differences, types of borrowing. You do two types of borrowing: specific borrowing and general borrowing. Now, as you keep on incurring cost, you keep on capitalizing your interest. Now, the commencement from the day zero, the day you start incurring cost, you can start capitalization of interest. Now, if let's say suddenly there is a stoppage in the construction process, there is a disturbance in the construction process, which is a suspension of capitalization. Now you also suspend the interest capitalization, even though you will continue to incur the interest cost, right? You are not allowed to capitalize, right? So capitalization is suspended in which active development is suspended. It is not suspended when the substantial technical and administrative work is being carried out. Temporary delay is a necessary part to prepare an asset for its intended use or sale, right? That's an area of judgment. And again, you got to be careful that whether it is abnormal or whether it is normal. If it is abnormal, don't capitalize, because if you're allowed to capitalize, what does it mean? You're inflating your balance sheet, and that's where accounting is a principle based on conservatism, right? Don't inflate your balance sheet. So if there's an abnormal cost, don't capitalize. If it is a normal delay, normal disturbance, you continue to capitalize the interest cost. When will you stop capitalizing? Is when that construction is complete, right? So when it is ready to be used, right? When it is not put to use, it may be a situation that this plant is now ready to use, but you haven't yet started the commercial production. That's your problem. If it is ready to be used and you're waiting for a date, look, this is the good Subh Muhurt, I'm going to wait for this Muhurt date and then only I'm going to start the production, you can't continue to capitalize the interest. So if let's say 1st of December is when the construction is complete, even though you have decided not to start the production and then you're going to start the production on 1st of February, now the period interest cost which you continue to incur during this period, that's nothing but charge to P&L. All right. So you're going to suspend cessation of capitalization, substantially all the activities which are necessary to prepare the qualifying asset for its intended use or sale are complete. All right. If that been the case, you will stop doing the capitalization of interest. Otherwise, you continue to capitalize unless there is an abnormal delay. If there's an abnormality, you stop capitalization. Now, as you keep incurring cost, that is where you keep on capitalizing. If it is again a specific borrowing, if there is an interest income during this period, you again reduce that, from the cost of the capitalization itself, right? If it is a general borrowing, it doesn't bother you because you only capitalize with reference to the expenditure which you have incurred. So there is no question of any income in relation to any general borrowing pool from that perspective. The important thing for you to remember is that how do I determine the rate of interest which I need to use for the purpose of general borrowing or for specific borrowing. Specific borrowing is what is already written in that agreement, which is an effective interest rate method, right? That is what you will follow. For general borrowing, you may have to compute the general borrowing rate if you have multiple borrowings at different rates. If they're all borrowings are at same rate, it doesn't bother, it doesn't matter. But if there are multiple borrowings at different rates, that is where you got to apply your mind and then do some computation, and it is weighted average. You got to weighted average cost of capital. Many times, I've seen in that exam question that there is a change of interest rate, right? So for first 3 months, interest rate was charged at 8%, and then interest rate was charged at 10%. So you got to again weight it for the time period as well. You got to be careful, right? Make sure you read the question properly before you start jumping to the answer. That I know the answer, but make sure that you read the question carefully. There are some more details in the question, right? Okay, so we talked about the borrowing cost. Now we move forward to talk about intangible assets, right? So we've already talked about tangible asset. Tangible asset, something which I can touch and feel, right? Touch and feel, which is my land, building, property, plant and equipment, furniture, fixtures, etc. Now, what is my intangible asset? Intangible asset, which I can't touch and feel, which I just, in a way, I know I have it, which is very, very valuable, but I just can't touch it, right? From that perspective. So what are examples of intangible asset? Patent, copyright, trademark, R&D assets, so on and so forth. These are my, let's say, movie production rights. All of these are your intangible assets. Customer relationship, data, right? Data is a form of intangible asset. Okay. Now, how do you so what all is covered as part of the scope? So we got to focus on what is not covered from that perspective. So things which are like financial assets, things which are assets which are held for sale, or a deferred tax asset, or a lease asset, or intangible asset arising from employee benefit, or a contract cost. These are not covered as part of the standard. You go to again the respective standard. Like financial asset, we're going to talk about this under Ind-AS 109, for example. Intangible asset held for sale, you go to Ind-AS 105. Deferred tax asset, you go to Ind-AS 12. Leases, you go to Ind-AS 116, right? Employee benefit, go to Ind-AS 19. Contract cost, go to Ind-AS 115. Exploration asset, go to Ind-AS 106. So if there is again a specific accounting standard, go to that standard, right? Otherwise, I'm going to focus on this standard. So now, what is an intangible asset? We talked about what is an intangible. Now, let's talk about the recognition criteria of an intangible asset. When does it meet the recognition criteria? So intangible asset, something which has to be identifiable, right? It has to be an identifiable basis. What? Either it is separable or it is contractual, right? So it has to be identifiable non-monetary asset, which is either separable or contractual. Now, what is a contractual? Let's say many times you see, this company got acquired, this promoter sold out, and as a result of which they have signed a non-compete agreement, right? Now, non-compete agreement is nothing but an example of a contractual intangible asset, right? Let's say you acquired a company, as a result of that, you acquired a distribution right, right? Now, distribution right is nothing but a contractual right. Similarly, when you acquired a company, let's say you here acquired a customer relationships. Customer relationships could be of two types. One is a contractual customer relationship, which is like there are multiple SOWs, purchase orders I already have, which I'm going to execute in future. That is a contractual customer relationship. There are many times that I don't have signed customer contract, but I have a large number of customer base and I've been doing business with them. I know they come and they do business with me, so on and so forth. That is called non-contractual customer relationship in a way. So that is an identifiable and separable, right? From that perspective, may not be contractual. So you got to, let's say I'm doing an R&D, right? That's also in a type of an intangible asset, may or may not meet the recognition criteria. Why? When do you again look at the, if you're doing an internally, so there are again two types of intangible asset, right? One is an internally developed intangible asset. The other one is an acquired intangible asset. If you are acquiring an intangible asset in, let's say, in a business combination, it is easy to do accounting. You get a fair valuation done and you record them as an intangible asset. If you are doing a self-generated intangible asset, that is where it is very, very difficult, right? So for example, I spent a lot of money on advertisement, as a result of which I've created my own brand in the market. Now, if you self-generated brand, it is not allowed to be recorded as an intangible asset. For example, self-generated goodwill is not allowed to be recorded as an intangible asset, right? Now, I've done this copyright, right? Or I've done this research work. Now, not everything is allowed to be capitalized. So while you're doing a self-generated intangible asset, you got to divide the cost into two components. One is the research phase, and the second is the development phase. Anything which you incur during the research phase, all of that has to be expensed as incurred. Anything which you've done during the development phase, that is allowed to be capitalized, provided you meet some more conditions. So if you're doing a purchase of an intangible asset, purchase consideration acquired in a business combination is a fair value. If you acquired multiple assets, then you got to allocate the cost. If it is under government grant, I talked about how do you deal with this government grant accounting. If it is internally generated, expenditure incurred only in development phase is allowed to be capitalized. The expenditure which is incurred during the research phase is not allowed. Advertisement costs are just not allowed to be capitalized. They are always expensed as incurred. Cost comprises of purchase price, non-refundable taxes, minus trade discount, minus rebate, etc. from that perspective. Now, we have understood what is an intangible asset. We've also understood how do you do initial recognition of an intangible asset, right? Now, the question is, how do I do subsequent accounting for intangible asset? So subsequent accounting for intangible assets, similar to your property, plant and equipment, you can again do cost model or revaluation model. Now, the only distinction here for the revaluation model is presence of an active market. You are just not allowed to follow revaluation model unless there is an active market exists for that type of an intangible asset, right? Which is not the requirement for the revaluation model for tangible asset, right? If you have a tangible asset like building, plant and machinery, you can follow revaluation model, get it fair valued, right? Increase or decrease. I told you, you're going to record it through OCI. The same thing, if you were to do revaluation model, increase or decrease will go through OCI. Decrease below the cost, that goes to profit and loss account. Decrease below the cost, that goes to profit and loss account, right? And all then, so you do a cost or revaluation. Again, as I said, tangible asset out of 1,000, you may see one company doing fair value. Intangible asset out of 100,000, you may see one company. That also very difficult to find. Why? Because there is no active market ordinarily which exists for intangible asset, right? There is no active market where there's a buying and selling happening. So it's just not there. I personally haven't experienced a company doing fair value accounting in a way for intangible assets, so to say. So now we've understood the initial measurement and we've understood the subsequent measurement, but you also have to do amortization of your intangible asset. How do? I got to again determine what's the useful life, what's the residual value, all of that I need to determine here as well. So if I have a useful life of let's say 10 years, I'm going to depreciate it over a 10-year period using more likely, let's say, your straight line method. Is that what we commonly see? There are few examples which we see where is an indefinite life intangible asset, whereas goodwill as an intangible asset is mandatorily required to be tested for impairment. It is considered as indefinite. Try and understand the difference here, right? A life is indefinite versus infinite, right? There's nothing called infinite from an accounting perspective, right? Infinite, there's nothing called infinite. It is indefinite. What's the meaning of indefinite? Is you are not able to determine the life of this asset. If you're not able to determine the life of this asset, then you need to do an impairment testing. You need to do an impairment testing annually. Annual testing of impairment is what is required, from that perspective. So that's how you do accounting for intangible asset. I've already talked about for an internally generated intangible asset, I'm going to do charge to profit and loss account, all the research phase for the development phase. Once the technical feasibility is established, I have an intention to complete the intangible asset. I have the ability to use or sell it in the market. It will generate probable future economic benefit. I meet all these criteria, then I'm allowed to capitalize it. And if it is a qualifying asset, I can also capitalize the interest cost. From that perspective, I need to test it for impairment. If there is an, in a way, impairment loss, all of that is what I need to, in a way, consider. I'm going to talk a little more on the impairment to all of you. Now, if again, when I'm going to de-recognize this on disposal, or when there is no future economic benefit, right? So we've talked about intangible assets where there is no physical substance, right? Patent, copyright, software, trademark, etc., goodwill, a brand. All of these are types of intangible asset. How do you acquire? How do you get hold of them? Either you acquire them in an external transaction or you self-develop them, right? Now, for capitalization rules for self-developed intangible asset is high. The bar is very high. So if it is a research phase, you got to expense. If it is development phase, you are allowed to capitalize provided you fulfill criteria like technical feasibility, intent and ability to generate probable future economic benefit, etc. You can capitalize. Advertisement costs are always expensed as incurred. Always expensed as incurred. Self-generated goodwill is never allowed to be recorded as an asset, right? Never allowed to be recorded as an asset, right? Now, how do once I have done this is an asset. Now, initial accounting is at cost, subsequent accounting is at cost or revaluation model. Very, very rare for revaluation model. Why? Because there is never an active market for these intangible assets. Provided, let's say if the exam says there is an active market, then of course you can do a revaluation model. If you do a revaluation model, then any upside increase in revaluation that goes to OCI, downside revaluation below cost that will go to profit and loss account. Okay, then I also need to amortize the intangible asset. The amortization of intangible asset is with reference to useful life and residual value. If it is finite, then I'm going to amortize it over its useful life. It is indefinite, not infinite. If it is indefinite, then I'm mandatorily required to test it for impairment at least on an annual basis or more frequently if there are conditions which is out there. So I hope you clear on intangible asset guidance. Now I'm going to talk to you about impairment of assets, right? When do we need to test assets for impairment? So COVID-19 was a in a way big trigger for impairment assessment. In a way, it resulted into a huge amount of business disruption across the board. Every sector, every industry got impacted because of COVID-19. So that's the trigger for impairment. So at what level? The whole question is, when you think about an impairment, right? Now, what is it you will impair, right? You will only impair your assets which are there on your balance sheet. So am I going to start impairing every asset or any asset? No, you anyway record depreciation, amortization for your assets, right? Now let's just think about this. So then why this standard is required? So what this standard then say, you got to look at your cash generating units, right? You got to look at your cash generating unit, which is CGU, because you are doing accounting. How are we doing accounting? We're doing accounting based on historical cost, right? We're doing accounting based on historical cost. And my assets, anything which qualifies as an asset, means what? It is supposed to generate probable future economic benefit. It is supposed to generate future economic benefit, which is help me to recover that cost of that asset which is sitting in my balance sheet. But there are several times in our life when we believe that this is an asset, but actually this is not an asset, because there is no benefit which I will be able to generate. So if I will not be able to generate any benefit from the use of those assets, then I need to test them for impairment. So impairment testing is not a mandatory requirement on a year-on-year basis, except for indefinite life intangible asset or for goodwill life, where I need to mandatorily test it for impairment. Otherwise, you will do impairment testing only when there are triggers, triggers like COVID-19, triggers like disruption in my business, triggers like change in law, triggers like there is a new competition in the market, triggers like there is a huge disruption in the raw material prices. So if there is a disruption, technological obsolescence or change of management plan, new competition, so that I will not be able to generate future economic benefit to recover the carrying cost of my asset in the balance sheet, that is a criteria for impairment testing. That's the criteria for impairment testing. And then at what level you going to test this, right? I'm going to test in a way for impairment testing at a cash generating unit, right? At a cash generating unit. What are my indicators here? My indicators are obsolescence, significant adverse change affecting the asset, there's a decline in asset value, change in the external environment, change in the interest rate, reported net asset exceeds its market capitalization. Many times what happens that, a lot of our Indian banks, right, the carrying value of their capital per share is 100 rupees, but they trade at 40 rupees. That means what? The market doesn't believe that they will be able to recover the assets, right, at what value they show in the net worth. They are not even getting worth of their net worth, in an external transaction. That's a trigger for impairment. That means what? The market is telling you that your carrying value of asset is inflated. If it is inflated, you got to record an impairment loss, right? Now, how do I record impairment? How do I determine that, is there an impairment loss? So you got to determine impairment at an individual asset level or at a cash generating unit level. At a cash generating unit where there's a discrete fine. What is a cash generating unit? It is the lowest component at which you are operating from a business perspective, at which the discrete financial information is available. That means you can actually go and build out your profit and loss account, that these are the assets which I'm using for this business unit, and then this is my revenue, this is my expenses, this is my return, from this business unit, from this perspective. So there is again a degree of judgment which goes and play a role, that what are my CGUs, from this perspective. Now, once you have determined that these are my CGUs, then you got to determine your what is my recoverable amount, right? So what's the impairment? Impairment is basically highest of value in use, or in exchange, in a way, so to say. So if I were to sell this, how much I'm going to realize? Okay, if I'm going to sell this, how am I going to realize? Or if I were to continue to use this, okay, how much benefit I will be able to generate? So in use or in exchange, recoverable amount is in use or in exchange. Okay, value in use. So if I were to continue to use, how much I'll be able to generate? And if I were to sell it, so for example, if there's a carrying value of an asset of 100, right, then you got to determine your recoverable amount in a way for this asset, right, recoverable amount, and that you determine with reference to in use or in exchange. in use, let's say if that number comes to 80, if I were to sell it in a market transaction, that number comes to say 90. That means there is an impairment loss of 10 rupees. Carrying value then has to be compared with the higher of value in use or in exchange, which is a recoverable amount, and that means there is a 10 rupee of impairment loss. In this example, recoverable amount is higher of the value in use and fair value less cost to sell, in a way. And cash generating unit is nothing but the smallest group of assets that generate cash inflows from continuing use that are largely independent of the cash inflow of other. How you determine the value in use? Again, you apply the discounted cash flow method, where you fast forward your future cash flows discounted to the present value. A lot of assumption goes into projecting your P&L. Then you have to do a discounting of your cash flows. All of that, then that helps you to determine your present value of your future cash flows. If you have goodwill, that goodwill also you need to allocate. So many times we struggle to say, how there in a cash generating unit, there are some unallocated asset, right? So there was a question on that. So you got to understand the methodology of allocation of unallocated assets to different CGUs, right? If they are not allocable, then you may have to test the impairment at a higher level, right? At a high, let's say a corporate headquarter building. When you're testing it for impairment, may not get allocated to individual CGU. Then you want to test it at a higher level, and there are all methodologies which are out there which you need to look at very, very carefully. Now, if you have recorded an impairment loss for goodwill, that is not allowed to be reversed. Okay, once recorded, not allowed to be reversed. However, if you have recorded an impairment loss in a way for other cash generating unit, and there is a subsequent period in a way increase in the carrying value of those assets, you are allowed to reverse the previously recorded impairment loss. But on goodwill, you are not allowed to record the reversal of the impairment loss in a way from that perspective. So remember, impairment of asset, I need to think through what is my cash generating unit, right? Once I've determined my cash generating unit, I need to then think through, is there a trigger for impairment? If the answer to that is yes, there is a trigger for impairment. We talked about, there is a disruption in the business environment, or I may not be able to generate sufficient future economic benefit to recover the carrying cost of my asset. Then I need to start testing. How do I test? I'm going to compare the carrying value with the recoverable amount. Recoverable amount is the higher of value in use or fair value less cost to sell. And then how do I determine the fair value in use? Fair value in use is nothing but discounted cash flow. I'm going to figure out by doing a cash flow forecast, and once I determine value fair, and then the fair value less cost to sell is the exit price. We're going to talk about that exit price under Ind-AS 113. The higher of the two, compare that with the carrying value. If there is an impairment, that's an impairment loss. And then there are some more complications. If there are unallocated asset, how do I allocate? Then how do I apportion this impairment loss to the number of assets which are forming part of that cash generating unit? And you do an allocation based on a pro rata basis, subject to the condition that should not reduce the realizable value of that asset in that asset group. The first allocation goes to goodwill, right? Wipe out the goodwill to the extent it is possible. Then if the goodwill has fully been written off, then still there is an impairment loss. Then the balance you allocate to the other assets which are forming part of your cash generating unit from that perspective. Goodwill, once written off, is not allowed to be written back. Other other losses in your cash generating unit are allowed to be written back, subject to the recovery to the extent of carrying value of the cost, in a way from that perspective. Moving forward, right, to talk about non-current assets held for sale or discontinued operations. This is Ind-AS 105. Ind-AS 105. So now there is an asset group which you have, which you intend to in a way sell out, right? Or you don't intend to continue to use it for the purpose of your business, right? So it is a component of an entity. This is a component of an entity that either been disposed of or classified as available for sale. It represents a major line of business or geographical area. It's a part of a single coordinated plan to dispose. Now that's an asset group which is held for sale. What is again scoped out? Deferred tax assets, financial assets, agricultural assets, employee benefits. These are all scoped out. So you got to look at your asset group, which you now believe that I'm going to sell it. I don't intend to continue to use it. Now, when do you classify this? That this is, so you got to meet certain conditions, for you to classify any group of asset as assets held for sale. What does that mean? Asset has to be available for immediate sale in present condition. Now, let me give you a simple example. Let's say you're a plant and machinery and you say that I want to classify this as held for sale, but you are actually running an existing order book. If you're running an existing order book and I need to actually, I'm under a contractual obligation to continue to use this plant and machinery, to continue to produce from this plant and machinery to fulfill my contractual obligation. What does this mean? Then this is not in a condition which is available. However, you can demonstrate that if I have a buyer, I can exit from my contractual obligation at any given point in time. If you can exit from your contractual obligation at a given point in time, that means it is available for sale in its immediate condition or in present condition, and sale must be highly probable, and we will talk about some of these probable criteria and the meaning of this when we talk about Ind-AS 37. So sale is highly probable in a way from that perspective. So management must be committed to a plan to sell. The buyer and there's a buyer. I'm going to locate a buyer. So all of that is what I need to think through, that there are these criteria are met in a way. It is held for sale when I, as management, I'm authorizing this. I'm looking actively for the buyer. I expect to complete the sale process over next 1 year, right? I'm actively marketing that at a reasonable price. All of this, then you classify them as held for sale. Now, once you have classified anything as held for sale, then what do? You do an immediate assessment of carrying value and market value. If the market value is lower than your carrying value, there's an immediate impairment loss which you need to record. If the market value is higher than your carrying value, you stay at the carrying value, but you stop charging the depreciation on that asset group which is held for sale. If it is asset group which is held for sale, then you will stop charging the depreciation. But there is an impairment trigger as well. If the market value is lower than the carrying value, then you will record an impairment loss. You will not test the value in use, because here you don't intend to use this asset for your own production process. You intend to sell this. So you only compare this with the fair value less cost to sell. And now whatever the value in a way comes through, that's the initial recognition, lower of carrying amount and fair value less cost to sell. Subsequent recognition at fair value less cost to sell. And if there is any reverse impairment loss, you will continue to recognize this. If there is a change in plan, then you want to recategorize them from held for sale to held for use. And then you want to reassess the depreciation which you've not charged, and then you may have to charge all the past depreciation as well on a cumulative catch-up basis, and then you need to look at the presentation and disclosure. Now that's where again there is a lot of focus in this standard to say that if it qualifies as a discontinued operation, then you got to disclose them appropriately in your balance sheet, in your P&L. If it is not a discontinued operation, then you don't change the previous period comparative financial statement. You disclose them in the current period financial statement. So all in all, when you think through all your assets category, property, plant and equipment, the tangible asset, the intangible asset, the impairment, the borrowing cost, the inventory accounting, and then the asset held for sale, including the government grant. Now, all of them, in a way, focus on the recognition principle, focus on the measurement principle, the initial measurement, the subsequent measurement. All of that is what will give you a good perspective on how do you deal with accounting for the asset side of the balance sheet, right? Now we talk about the liabilities, and we're going to quickly talk about Ind-AS 37. Now, when you see there's not a whole lot of questions which have come through, on contingencies. There's one question. Ind-AS 116 is yet to be tested, and we will talk about both of these standard fairly quickly. So Ind-AS 37 talks about provisions, contingent liabilities, and contingent assets, right? Now, what are your provisions, so to say, or what is this whole contingency in a way all about? So when you think about a liability, what is a liability? Liability is something which is arising from is an obligation, is a present obligation which is arising out of past events, which results into an outflow of resources from the entity, right? So it's a present obligation arising out of past event which will result into a outflow of resources. That's the definition of liability. Many times liability contractual in nature is very clear. This is what I need to pay. Many times I need to make an estimate of how much I need to pay, from that perspective. And then there are some contingencies associated with it, whether I need to pay or I don't need to pay, which is like litigation, right? Which is like warranty, for example. So, you sold a car. If I've sold a car, now I've given a warranty commitment. There is may or may not happen, the guy may or may not experience a defect in the car. So there is an uncertainty, right? Now there are different degrees of uncertainty, so to say. What one is we call as something called remote, right? Then something we call it as possible, right? Then we call it as probable, then we call as highly probable. Then we call as virtually certain, and then we call, let's say, certain. All of these are different degree of probabilities. If it is remote, means less than 20-30%. If it is possible, means 30 to 50%. If it is probable, it means more than 50%. If it is highly probable, means 70 to 90%. If it is virtually certain, means it is 90 to 95%. If it is certain, means it is 100%, right? So you end up recording an liability if it is probable. If the likelihood of outflow of resources is probable and it is measurable, it is reliably measurable, then you are supposed to record a provision for a potential outflow, right? For a potential outflow at the present value. If you expect that this outflow will happen after 3 years, you got to discount it to the present value under the principle of Ind-AS 37, right? So how do you measure it? Make best estimate, consider risk and uncertainties, use the present value for long-term provisions, future impact, future events, and disregard your expected disposal of assets. Okay, so I think what I'm just trying to say that what you got to first determine, is this an obligation? Obligation arising, it's a present obligation arising out of past event. What does this mean? This car is already been sold. So if I have an inventory of cars, I've yet not sold the car, I don't need to make warranty provision for those cars because yet to be sold. That means it is not my present obligation out of past event. Once I've sold it, that is history. Once I've sold it, that's a past event. Now that's a present obligation which results into outflow in the future period. So that is where the whole concept of provision or contingencies in a way come in, and then there are different degrees. So when you record it, if it is probable, means what? It is more likely than not, more than 50%, and it is reliably measurable. You are in a position to measure best estimate of provision. How do you measure them? You may measure them based on most likely outcome. If there are two possible outcome, you say, okay, I may pay 10 rupees, I may pay 5 rupees. You try and pick one among the two, or there is an expected value outcome approach to the range of outcomes. Then you assign probabilities to those outcomes, and then you compute what is the likely outflow. So there are methodologies which you may need to apply to determine, depending upon, again, follow the question, determine is there something being asked specifically, and then you can apply them. So you got to look at, is there a legal or a constructive? There is another thing which is another important concept is called constructive obligation. A constructive obligation is something which is not contractual, but is an impression which I have created in the mind of the recipient that this is what I'm going to do it for you. If this is what I'm going to do it for you, and I've created a valid expectation. I've created a valid expectation in the mind of the recipient. That also is like a liability or an obligation, becomes a present obligation, and I may require to record it. Now for contingent assets, unlike a liability which you need to provide for if it is probable, a contingent asset you only record as an income and an asset if it is virtually certain. If it is virtually certain means what? If it is more than 95% threshold is what you have crossed, then only you record that as an asset. Otherwise you will continue to disclose them on a contingencies and a liability. You want to record them if it is probable, and you are also able to measure it reliably at present value, discounted if it is to be paid beyond 1 year, in a way from that perspective. Now we move to talk about leases, right? What is a leases? Let's say if you're staying on a rented apartment, right? If you're staying in a rental apartment, that's nothing but a lease arrangement between you and the landlord, right? Let's say you've taken a car on a lease, that's a lease arrangement, right? Many times we take a building on a lease. Many times we take plant and machinery on lease. So what is a lease? Again, lease is of a tangible item, right? Of a tangible item, which is your property, plant and equipment, land, building, plant and machinery. Okay, so you lease furniture, fixtures, a tangible assets. You got to lease a tangible asset in a way from that perspective. So now, if you're leasing a tangible asset, what does this mean? That I have a right to control. I have a right to control the use of an identified asset for a period of time in exchange for a consideration. Right of control, the use of an identified asset for a period of time in exchange of consideration. So there are two important things which is important, there has to be an asset which is identified, and I have the right to control the use. When I say there's an asset which has been identified, that means what? There are no substantive substitution right. For example, if I've entered into with a taxi provider to say that, I need a taxi at 10 o'clock at my doorstep every day for next 2 years, right? Now the question is this a lease arrangement or a service arrangement, right? Now if the taxi service provider say, okay, I'm going to make sure that there is going to be a Toyota Corolla at your doorstep at 10 o'clock every morning, right? Now that's a service arrangement, right? Now if your arrangement was, I'm going to make sure that you will have a Toyota Corolla of this number, of this chassis number, same car will come to your doorstep at 10 o'clock and you are the only user of this car. There is no other person who's going to use this car, whether there is a need or not. This car is exclusive for your purpose. That means there are no substantive substitution, right? That is a lease arrangement. Same example, it can be understood as a service arrangement if the asset is not specifically identified and I have the control over that particular asset, not that type of asset category, about that particular asset is what I need to have control. Okay, so if I have that control, that's an identified asset and I can direct the use of that asset, and in exchange I have to pay you a consideration. That's my lease obligation. So now from a lessee perspective, so in a lease arrangement there are two parties, a lessor and a lessee. A lessee which is taking the asset on the lease, a lessor which is giving the asset on the lease. Now when I look at an accounting from a lessee perspective, a lessee is going to record a right of use asset and a right of use lease liability. What is the right of use asset? So if I have taken this asset on lease for a 3-year period, I'm going to look at what is the total rental commitment I am making for a 3-year period. So what's the cancelable period which I have, non-cancelable period over which I can't exit out of this arrangement, or the period over which I intend to continue, including the renewal clauses. So I'm going to assess my lease period. Once you determine this is my lease period, and then how much is my lease rental I need to pay over that lease period, discount it to the present value. The present value of lease liability, add the direct cost, add the dismantling cost, add any prepayment payment. Prepayment payments are nothing but advance payment if I made, right? Because that I don't need to pay in future. So I've already paid, or I paid a security deposit. The interest which I'm foregoing on that security deposit, a component of that is also a prepayment payment. If I've received any lease incentive, reduce it. That is my carrying value of right of use asset. And similarly, I'm going to compute my lease liability, which are all the payments I need to make. If they are variable payment linked to an index, if there are exercise price of a purchase option, if there is a penalty for termination, if there's a residual value guarantee, all of that in a way going to be my lease liability. So on my right hand side of the balance sheet, I need to record a lease asset. On the left hand side of the balance sheet, I'm going to record my lease liability. There are certain exceptions. If let's say the lease agreement for less than 12 months, I may decide not to do this accounting. I may decide not to complicate. I may say, I will just account as you go. As every month I'm going to pay you rent. Every month I'm going to record the expense. If this is a low value asset, right? I don't want to bother myself with the complex accounting for a low value asset, right? Now, what is low value is not defined. So you need to define that threshold. Say 5,000 is low value, say 10,000 is low value, say 20,000 is low value, or 50,000 rupees is a low value, is something what you need to determine and disclose and again follow it on a consistent basis. There are many arrangements we see that there are lease component and non-lease components which are clubbed together, right? For example, if you take a building on a lease, you also get maintenance, right? Building and along with the maintenance, you have to pay 50 rupees square feet for the rental, and you have to pay 5 rupees square feet for the maintenance. So the lease the lease component is 50, the non-lease is 5. You have an accounting policy choice. In a way, you can combine them, you can separate them, and do accounting appropriately. So there are some accounting policy choices which are made available under the standard, right? And then once I have recorded a right of use asset, you need to amortize that right of use asset over the lease life, right? If you have recorded a right of use lease liability, you got to keep on paying that liability and unwind that liability and record the interest cost in your profit and loss account. Similarly, from a lessor perspective, so there is no concept of finance lease and operating lease in a way from a lessee perspective, right? But from a lessor perspective, the concept of finance lease and operating lease in a way continues. So if it is a type of lease arrangement where substantially the risk and reward of the ownership have been transferred to the lessee, in a way, I'm going to de-recognize that asset. I'm going to de-recognize that asset. I'm going to record the gain or loss, and then I'm going to record the interest income over the period of the lease. If it is an operating lease, not a finance lease, then I'm going to keep on recording that asset, keep on depreciating that asset, and keep on recording the rental income in my P&L. Now, the rental income in the P&L will be recorded on a straight line basis. So many arrangements we see in year 1, the rent will be 100. In year 2, the rent will be 120. In year 3, the rent will be 160. Then you got to straight line the lease, provided the lease term is 3 years. That if you can't exit out of this arrangement, and if you were to exit out of this arrangement, there is a termination penalty. If there's a termination penalty, that means that in a way is a significant disincentive for you to exit out of that arrangement. So, and then there are a host of disclosures. The lease accounting got recently introduced. It has fundamentally changed the concept of lease accounting from a lessee perspective, and from a lessee perspective, the concept of operating lease and finance lease has been done away with. So whatever is your lease arrangement, you got to make sure that is the asset is an identified asset, and I have control over the use of an identified asset. You fulfill both the criteria, then you determine your lease term. Once you determine your lease term, then you determine your lease obligation. Now this is my lease obligation, discount it to the present value, look at your initial direct cost, look at your dismantling cost, all of that. You got to then look at, is there any lease incentive I have received from the lessor, then capitalize your ROU asset. Similarly, record a liability liability for your lease liability, amortize your ROU asset over the lease term, continue to repay your lease liability and unwind the lease liability and record the interest cost. From a lessor perspective, nothing much has changed. You continue to figure out it is a finance lease or an operating lease. If it's a finance lease, de-recognize that asset, right? De-recognize that asset and record the gain on de-recognition or loss on de-recognition and record the interest income over the lease period. Or if it is an operating lease, continue to record the rental income, right? Continue to record the rental income and continue to depreciate the property, plant and equipment. Remember, again, right of use asset or liabilities again for tangible items in a way from that perspective. All right, now we move to the third section, right? Third section to talk about revenues and income taxes. Okay, so income taxes I'm going to cover very quickly, and then I'm going to spend some time on revenue recognition. All right, so what is income tax? Okay, and again, when you look at it from an exam perspective, revenue is very important topic, right? Every term they're asking a question on revenue recognition, so I'm going to focus on Ind-AS 115. But before that, income taxes means what? The tax which we pay to the government of India, which none of us want to pay, but we have to pay. It's important to pay taxes, right? So income taxes is what is covered under the Income Tax Act 1961. Okay, now what I pay tax, it has two components: current tax and deferred tax. Current tax is what you pay. Deferred tax arises because of the difference between accounting principles and tax principles, right? Now, let me give you a simple example. Your depreciation cost on your property, plant and equipment. On depreciation cost on your property, plant and equipment, you're doing here straight line method of depreciation. Accounting rule says do straight line. Tax says you have to do WDV. If you do that, it results into a difference between the carrying value of property, plant and equipment and in your books versus your tax. So you got to follow what is called a balance sheet approach. Balance sheet approach under Ind-AS 12 for you to appropriately determine your deferred tax. Okay, so compare your book base versus your tax base, right? And then divide all your differences between two types of temporary differences. Temporary differences are those differences which originate in one accounting period and go to reverse in subsequent accounting period. Okay, so these are two types of temporary differences: taxable temporary differences and deductible temporary differences. A taxable temporary difference results into recognition of a deferred tax liability. A deductible temporary difference result into a recognition of deferred tax asset. If you're recording a deferred tax asset, then it is subject to again recovery assessment, right? Recoverability assessment. And the recoverability assessment goes back to the principle of probability, that whether you will have sufficient taxable income in the future where you will be offset your deferred tax asset. So if you have a deferred tax liability, that means what? I have to pay higher tax in the future, right? I have paid lower tax now. I have to pay higher tax in the future. That is why I'm going to record a deferred tax liability today. You have a deferred tax asset in your balance sheet means what? You have actually paid a higher tax today than what you should have paid with reference to your book income, right? Government has taken more, right? If the government has taken more than what you should have taken, what you should have paid based on your book income, you record a deferred tax asset. That means your future actual tax cash flow will be lower, but your book income is supposed to be higher. That is where you're going to reverse this tax asset, and your deferred tax asset, your tax rate in a way then will represent your book income. So the whole purpose of tax accounting is to look at the country's statutory tax rate and try to mirror your tax expense in your P&L to that country's statutory tax rate, provided all these differences are temporary in nature and you have the ability in a way to make sufficient profits in futures as so as to ensure the recoverability of the deferred tax asset. All right. Lots of disclosures we are required to make. We have to make a disclosure of effective tax rate reconciliation. I have to make disclosure between current tax, deferred tax asset in current and non-current, all of that. The deferred tax asset or liabilities are not allowed to be discounted. You don't do discounting of deferred tax asset or liability, even though they're likely to be settled in foreseeable future, say 1 year, 2 year, 3 year, 5 year, 10 years. you are not supposed to do discounting. Unlike a liability which you record under Ind-AS 37, you got to record them at present value, but a deferred tax liability, you are not allowed to discount. No discounting is allowed for recognition of deferred tax. So compare your book base with tax base and record, a deferred tax asset or a liability in a way from that perspective. This subject has not been tested, but again, I did a detailed conversation on this in the previous webinar. Feel free to look at that and try and understand some more concepts around this. Okay, now we will talk about revenue recognition. Okay, revenue recognition. So what is revenue, right? Revenue is what the central operation of that any legal entity. That's the purpose for which you exist, unless you are an NGO for it, right? So that is what your purpose is, that I'm going to sell goods or rendering services, right? Either I'm selling goods or I'm rendering services, or I develop certain assets on which I'm either doing a earning of interest, royalties, or dividend, right? From that perspective. So what's the purpose? Our purpose is to earn money. Revenue is the whole earning process, right? So the whole question is that, again, you got to look at what all is scoped out from the standard. So leasing, insurance, financial instrument, for which I have again a specific standard, that's not covered here. Okay, if I have a specific standard, that's not covered here. Otherwise, I'm going to look at a revenue recognition. Now, for me to look at revenue recognition, I'm going to look at a 5-step approach. It's a 5-step approach. All right. Step number 1, identify the contract with the customer. Do I have a contract with the customer? What does that mean? A contract is something which is enforceable at law. Is there a buyer and a seller? Contract means there has to be 2 parties. There has to be 2 parties. You can't do contract with yourself. There has to be 2 parties. There has to be a buyer and there has to be a seller. So is there a contract? If there is a contract, means it has to be enforceable at law. It could be oral, it could be written, right? It could be over an email, for example, provided it is enforceable at law in that jurisdiction. If it is on WhatsApp, good luck to you, right? So you got to ensure that this is enforceable at law. All right. Now, assuming that there is a contract. Now, what does that mean? Do the contract identifies all the terms and conditions? For a contract to be valid, it has to be identify all the terms. What is it I'm going to sell? In exchange, what is it I'm going to receive? Over what period I need to sell, over what period you are supposed to pay, how are we going to do the settlement? If we don't execute the contract, what are the termination penalties, right? Now, so all of this needs to be specified for you to say there is a contract between party A and B. That's step number 1. Then I go to step number 2, is identify all my performance obligation under the arrangement. Then I go to step number 3, is determine the contract consideration. Then I go to step number 4, allocate the performance obligation to each of the allocate the contract consideration to each of the performance obligation. Then I go to step number 5, is record revenue as each of the performance obligations are fulfilled. So it's a 5-step approach for you to look at revenue recognition. So remember, what are those 5-step approach? Identify the contract with the customer, determine all your performance obligation, determine the transaction price, allocate the transaction price to each of the performance obligation, and record revenue as these obligations are fulfilled. And I talked about, when you think about a contract with the customer, right? Do I have a contract terms? Do I need to look at combination of certain contracts? Is there a contract modification? These are my complexities when I look at identification of a performance obligation, right? Now, let's say, there are several schemes which keeps going on. Sir, you buy this iPhone today, you will get a discount on these AirPods after 3 months, right? Or 5,000 rupees. Now, the question is there a material right which I'm offering to a customer? If the answer to that is yes, that also is a performance obligation. Sir, you buy this car, you will get the maintenance free, for a period of 3 years. Come to my workshop, I'm going to give you a free service over a 3-year period. There is nothing called free. Nothing is free in a commercial transaction, right? Everything has been bargained for. You've been charged for everything which has been promised. The key is to determine all the obligations of the seller, all the rights of the buyer, right? For which you agreed to pay a consideration. So whether I'm selling a good, I'm selling a services, I'm selling multiple goods, I'm selling A, B, C, I'm selling a computer, I'm selling a software, I'm selling a maintenance, I'm selling an upgrade. So whatever you're trying to do, you got to identify all your performance obligations under the contract. There are many times in warranty arrangements, you have to see is an assurance type warranty or a service type warranty. Assurance type warranty is when you are giving a commitment for the performance of the product to a specified publication, right? This is what I've told you. This is what I'm promising you. This is what you will get. This is how it will perform. That is an assurance warranty, which is customary business practice. Now, if you were to say, I'm going to give service to you, you come and I'm going to do a free review of all the products, whether it's working or not, and I'm going to tighten it up and do this cleaning, etc. That's a service type warranty. That's a performance obligation. Okay, so when you look at a performance obligation, you got to be very, very careful of what all my obligations, what all I am promising to my customer under the arrangement. Once you identified a promise to your obligation, then you need to determine your contract consideration. Now, for this contract, what all I'm going to get, many times this is easy, which is fixed consideration. I'm going to get 100 rupees in exchange. Now, 100 rupees is okay, but say, okay, if you buy 100 units, I'm going to give you a discount, right? Now, if you buy in this period, I'm going to give you this discount. If I, let's say I'm doing a construction contract, if you finish this construction early, I'm going to give you early completion bonus. If your quality I like, I'm going to give you a quality bonus, so on and so forth. So there are variabilities is what we commonly experience in contract between two parties, where each party said there's a carrot and stick approach, right? I'm trying to incentivize the buyer to buy more. Similarly, buyer is trying to push the pressure on the seller to reduce the cost, or I'm incentivizing the contractor to do a better quality, and then I'm going to pay you more, right? So you got to understand the construct of the contract and then determine how much I am entitled for, right? What is my fixed and variable consideration? The variable consideration is, again, you got to assign a probability. Is it highly probable? Is the variable consideration, which I believe is highly probable. What is highly probable? Is likely to occur. Likely to occur means more than 70 to 90% threshold. 70 to 90% threshold, likely to occur, right? So now I determine my contract consideration. Once you've determined the contract consideration, then I need to allocate the contract consideration to each of the performance obligation. There are different methods of allocation. Do I need to do the methods of allocation could be a relative fair value method, for example. Okay, a relative fair value method. That's what we see very commonly. Then you have a residual method. Okay, this also is what we see. Then you have a reverse residual method. Okay, there are multiple methods of allocation. Okay, so what is relative fair value? Let's say there are two units which are being sold, unit A and unit B. Okay, and here it is sold for 1,000 and it is for 100. A total is 1,100, but actually you bundled them together and you say, I'm going to charge you 1,000 rupees as a composite price. If I'm going to charge you 1,000 rupees, whereas the standalone price of these two units are 1,000 and 1,100, so this discount of 10% is what I need to allocate to each of them on a relative fair value basis. So I'm going to allocate a discount of 90 to this and 10 to this in a way using a relative fair value approach. If I were to do a residual fair value, means what? I don't know the fair value of this component. I only know the fair value of the undelivered component, which is 100. If the fair value of the undelivered component is 100, I don't know the fair value of the delivered component. I'm going to allocate entire discount to the delivered component. Okay, entire 100 rupees will get allocated to unit A in a residual method. In a reverse residual method means I know the fair value of unit A, but I don't know the fair value value of unit B, that's a very, very, in a way, scary situation that you don't know fair value of the future obligation. If you don't know the fair value, then again, you allocate, the discount very, very carefully, to the delivered component. Mostly you're supposed to allocate discount to the delivered component and then undelivered component, but still you don't know how much is the discount. A discount is 100 or discount is actually more if you don't know the fair value of the undelivered component in a way from that perspective. So on and so forth. So that's how you will do the discount, allocation of your performance obligation. And once you have, then done the allocation and now you've delivered the goods to the customer, that is when you're going to record revenue. You've done the construction, that is when you're going to record the revenue. Many times you may do record the revenue over a period of time, like percentage completion method, or at a point in time. At a point in time when I fulfilled all my obligation, then I'm going to record. Over a period of time, that means there's a continuous transfer of control to the customer. There's a continuous ability to collect the consideration which is promised to me by the customer, right? That is when you will presume that there is a transfer of control over time. I'm going to record revenue on a percentage completion. Percentage completion, again, there are multiple methods, input methods and output method. You got to again apply a method appropriately for the purpose of measuring progress and transferring control. It could be at a point in time or over time. There could be some bill and hold arrangements. There could be consignment arrangements. There are multiple types of arrangement is what you need to be careful about. All of that is what you need to look at, from a revenue recognition perspective. And then the element what you need to think about is the contract cost, right? If you're incurring cost in relation to getting into a new contract, now that cost is also allowed to be capitalized, right? If provided it is an incremental cost. If it is an incremental cost, that cost is also allowed to be capitalized. Capitalized to be amortized over the contract term. So the revenue recognition is a new standard, Ind-AS 115, and then it follows a 5-step approach, including the guidance on contract cost. The 5-step means identify the contract with the customer, determine all your performance obligation, determine the contract consideration, allocate the contract consideration to each of the performance obligation by following a method of allocation, which I talked about. Could be relative fair value, could be residual value, could be reverse residual value, from that perspective, and then record it as you fulfill your performance obligation. Could be at a time or over a time, right? At a time, at a point in time, or over time. Over time means there is a continuous transfer of risk and reward, which is normally we see in a construction projects, right? Construction project. So whether you follow then an input method or an output method for the purpose of recognition of revenue in a way from that perspective, right? So, and then we talked about contract cost, right? If there are contract cost, incremental cost, which you have incurred in obtaining this contract, that also is allowed to be capitalized, to be amortized over the period of the contract. All right. So we've done with deferred taxes or taxes and revenue recognition. We're going to talk about presentation and disclosures before we're going to move to financial instruments, right? The most important standard here is your accounting policies, changes in accounting estimates and errors, right? That is what you need to look at it very, very carefully. And I'm going to help you understand some of these principles which you need to remember in a way to get it right. There was a question on operating segment, of course, on May 18, in a way, and what's an operating segment, what's a reportable segment, we're going to quickly, in a way, talk about. There was something around a fair value measurement in terms of principal market and most advantageous market and so on and so forth. And we're going to talk about some of that as well, right? So moving on to talk about the presentation of financial statement, right? Now, when you think about a presentation of financial statement under Ind-AS, what do you need? You need the balance sheet, you need the profit and loss account, you need statement of changes in equity, you need cash flow statement and you need disclosures, right? Disclosures of accounting policies and notes to accounts, right? So these are the different components of financial statement: your balance sheet, your P&L, your statement of changes in equity, your cash flow, and your significant accounting policies and other explanatory notes. That's the big construct of your financial statement. You have current and non-current, you have P&L and other comprehensive income. There's nothing called extraordinary item, nothing called extraordinary item. You can have exceptional item. At best, you can have exceptional item. You have statement of changes in equity, which is share capital, retained earning. You have then cash flow, where you can present cash flow using a direct method or an indirect method, from that perspective. And then there are several principles like fair presentation, right? Make sure, all the information presented gives sufficient information to the decision maker or the user of the financial statement. You have to make a statement that these are in compliance with Ind-AS. You got to follow the going concern principle. What is the meaning of going concern? That means you will continue to operate over the foreseeable future. The foreseeable future is defined as next 12 months. You have no reason to believe that you will go out of business in next 12 months. That is what is going concern. You got to follow accrual basis of accounting, record all your obligations, record all your rights, and not do a cash basis of accounting. That's an accrual basis. You got to do accounting for material items. For immaterial item, don't worry, right? You got to do offsetting if there are rights and obligations with the same counterparty and you have the ability to offset the two. Don't just inflate your balance sheet, present them then on a net basis. Frequency of reporting on an annual basis, you got to do more. Maybe you may need to do on a quarterly basis depending upon the requirement in a particular jurisdiction. You got to do comparative financial statement. So if you're doing for 2020, you got to have 2019 as a comparative period, right? And similarly, it has to be done on a consistent basis. All the accounting policies which you're using to prepare financial statement has to be applied on a consistent basis, on a year on year, right? So you got to remember, the construct of component is your balance sheet, your P&L, your cash flows, your statement of changes in equity, and all your disclosures and notes to account. The balance sheet gets divided into current and non-current asset, or a current and non-current liability. Then your capital account, cash flows you can present using a direct method or an indirect method. Very commonly we see indirect methods are being used by companies in a way from that perspective. This is the mandatory requirement, compliance with Ind-AS. That's the mandatory statement you need to make, that this financial statement is being prepared in compliance with Ind-AS. These are all attributes of your presentation of financial statement. Of course, you have Schedule 3 to also look at. Schedule 3 do prescribe what all we need to disclose, how we need to disclose, from that perspective. Okay. Moving forward to talk about accounting policies, change in accounting estimates and errors, right? So if there is a change in accounting estimate, okay, so first let's talk about accounting change in accounting estimate, okay. So if there is, what is an accounting estimate? Let's say you are making an estimate for your obligations, which is an employee benefit liability. Now, if there is a change in that estimate, that is to be accounted on a prospective basis in the future. See, accounting is a period concept. Accounting is a period concept. Every quarter, half year, full year, 9 month, that period is important for us to assess. And then the balance sheet is as on date. Balance sheet is as on date. Now, and accounting is based on estimate. Accounting is based on inexact science, as we say, right? It is not, mathematics in its entirety. It is based on judgment. It is based on estimates, so to say. Okay. So when we look at, let's say, accounting for several types of, let's say, warranty obligation, they are nothing but an estimate, right? Now, if there is any change in estimate, that estimate is to be accounted for on a prospective basis. Okay. That change in estimate is to be accounted for on a prospective basis. For example, if you change the method of depreciation, if you change the useful life estimate of your fixed asset, that change is to be accounted for on a prospective basis. That is to be considered as a change in estimate, not a change in policy. Important to remember, even for depreciation, even if you change the policy, that is considered as the method change in estimate, not as a change in policy. Why? Because it has a change in policy also is a component of how your pattern of usage is in a way is also changing, or your assessment of pattern of usage is changing, which is nothing but an estimate. All right. Now, so that is what we've talked about, a change in estimate. Now, if there is a change in policy, okay, which is to say, let's say I was accounting for government grant, right, as a reduction of cost versus as other income. That's a policy, for example. Or for example, I was accounting for leases of low value items. I decided not to account, but now I'm going to change this policy to account for this, right? Or there are several areas where you get a policy choice, right? You get a policy choice. If there is a policy choice and you want to change the policy, if you want to change your policy, you got to first demonstrate that the change is either required by Ind-AS or it results into reliable and more relevant information to the users of the financial statements. Assuming that you have concluded that its change is permissible. If this change is permissible and if this change is necessitated by a new accounting standard like Ind-AS 116 or Ind-AS 115, then you got to follow the transition provisions in that. Let's say do retrospective, do modified retrospective, do prospective. So the standard do prescribe the transition, you're going to follow that. Now let's assume that you decided to change something voluntarily. Let's say I decided to change the methods of inventory valuation. Instead of FIFO, I want to do a weighted average cost now. That's the change in policy. All right. Now, if that's the change in policy, you have to apply the change in policy retrospectively, unless you have a transition method which is prescribed in a new standard which you are required to adopt. So if you are doing status quo but you decided to change the policy, you will be required to change that retrospectively. Now, what is the meaning of retrospectively? If you are doing FY 20, you got to apply that. If you are doing FY 90, you got to change in FY 19 as well. And also you have to change your April 118 opening balance sheet. You got to disclose your opening balance sheet. You got to disclose your FY 19, recast your FY 19 and recast your FY 20 anyways. 20 you got to apply. So if there's a change in policy, it's retrospectively. If it's a change in estimate, it is prospective. Now, if there is an error, you have made in the financial statement, not in the current period. If in the current period, anyway, you will fix it, right? But if in the previously issued financial statement, you have discovered an error in the current period, then you have to go retrospectively and change the previously issued financial statement, fix it in the comparative period or in the opening period, depending to the period to which it relates. It is supposed to get accounted and adjusted in that period. So there is nothing called prior period item under Ind-AS 8. Okay, there is nothing called prior period item. You got to adjust this in the period to which it relates, and that's a very, very important change compared to the existing Indian GAAP versus Ind-AS in a way from that perspective. So remember all three. If there's a change in accounting estimate, it is prospective. If it is a change in accounting policy, it is retrospectively, unless you got to follow the transition provision of a new accounting standard from that perspective. If that is the reason you are changing, if you're changing voluntarily, you got to demonstrate that the change is better, and you got to change this retrospectively. If this is an error in the financial statement, you got to change for all the period. Error in respect to recognition, measurement or presentation, omission and misstatement. It could be because of oversight. It could be because of fraud, right? You discovered a fraud in the current period which belongs to the past period, right? If that been the case, you got to change the financial reporting for the period to which the fraud belongs, okay? So that all periods are then comparable in terms of like-to-like performance. Don't burden the current period for the sins of the past in a way from that perspective. So it is retrospectively, this assessed change in estimate is perspective, from that perspective. All right, let's now, I hope this is clear. Just make sure that the accounting principles are clear to you. Let's talk about event after the reporting date. Now, what is it we're talking here? So let's say we have to follow an accounting year, or we have to follow quarter year end, half year end, right? So either I'm following so let's this example is a company April 2019, March 2020 is my balance sheet date, okay? But 10th May is my reporting date. So there is always a difference between the balance sheet date and the reporting date when the financial statements are authorized for issue. Now, as I said, accounting is a period concept, okay? Now, if there is an activity or event which has happened between the balance sheet date and the date on which the financial statement are authorized for issue, which in this example is in between 31st March 2020 and 10th of May 2020, right? So then you need to identify those events and then say, are these events are adjusting event or non-adjusting event, right? That is where the questions in a way are being asked, right? So when you look at an event after the reporting date, what is the reporting date? Which is the balance sheet date, right? Which is your 31st of March. And then you look at the date of authorization of issuance of financial statement, which in this example is your 10th of May 2020, right? So anything which is happening after that date, after the 31st of March, so date of approval is when the financial statements are approved by board of director or by any other competent authority. So in this case, this information is what I need to be careful about. Is this what I need to be careful about from an evaluation or assessment perspective? Okay, and I may decide to publish it. There are 7 days, and then there is another 12 days, and there's another 2 days for filing with the shareholder or with the regulator sector. What is event after the reporting date? When we say, that means the date of the balance sheet, which is 31st of March, the date when the financial statements are authorized for issue. Then there are 2 types of events which are happening, favorable or unfavorable, which are categorized into adjusting event and non-adjusting event. Adjusting event and non-adjusting event, right? Now, what are those adjusting events? Adjusting events are those events which provide more information for conditions which were prevailing on the balance sheet date. Okay, for example, there was a debtor which was there in my balance sheet at 100 rupees. Now I then got to know on 5th of April, look, this guy is bad. This guy is not going to pay, which I believed on 31st March, this guy was likely to pay, right? Now, if I now know this guy is not going to pay, I'm supposed to then adjust this new information to my carrying value of that asset in my balance sheet. So that's an adjusting event. Now, what is a non-adjusting event? Something which has happened in relation to facts or circumstances which were not prevailing on the balance. Let's say now there is a fire. There is a fire which has happened in the godown of that buyer, as a result of which this guy is now on shaky ground, right? Now, the activity, the event of fire was not in existence on 31st of March. This actually originated after 31st of March. Hence, I'm going to account for this in the subsequent period, right? So, destruction of a major production plant by a fire, a major business combination, material non. So, if there are non-adjusting event, if there are material non-adjusting event, I may require to do disclosure. Otherwise, I will not do anything else. But if it is an adjusting event, I need to adjust the carrying value of asset and liabilities as on reporting date. Okay, let's say, I've invested in securities. There was a trading price of a security was 1,000 rupees on 31st of March, and that is what the asset value was in my balance sheet. Now, on 5th of April, there is a huge destruction in the carrying value of that asset, and that now the trading price is 600 rupees, right? The carrying value of that in my balance sheet is, let's say hypothetically, is 800 or maybe 1000 if I'm doing at fair value. There is a subsequent change in fair value. Now that will be accounted for in the future period. All right, because this change in fair value has happened because of subsequent factors. It has not happened. We often see some diversity in practice in inventory valuation related matter, right? To say that when I've determined my NRV, which was say 100, and now subsequently if there's a drop in the NRV, then what should be the NRV I should take? It is often very difficult to demonstrate that the NRV which you determined on 31st of March and there is a change in NRV on 10th of April, whether that change was because of the factors which originated after 31st of March, or those factors were also present on 31st of March in itself. And hence the actual determination on 10th of April is actually a reaffirmation of the conditions which were prevailing on the balance sheet date. All right. So we see some diversity in practice around that, but you got to be careful. In an inventory valuation situation, that's an area of judgment. But many other situation, you will largely be clear, so to say, that if you're getting more information for a condition which was in existence on the date of the balance sheet, that is an adjusting event. Otherwise, it's a non-adjusting event. Account for impairment, cost of asset purchase, or proceeds from asset sold. All of these are in a way example, so to say. There was a litigation which was going on. There's a litigation got settled, right? That means the litigation was already in existence. The subsequent information is only provided the amount at which it got settled, and hence you're supposed to adjust your balance sheet. Carrying value in a way from that perspective, right? Non-adjusting event, you got to disclose. There are certain exceptions in this. Let's say if you've distributed dividend after 31st March, that's a non-adjusting event, even though this dividend was in relation to the profit which you earned for 31st of March. It's a non-adjusting event. Going concern, as I said, you look at 12 months from the reporting date, but there is an exemption, so to say, exception, that if you believe that on the reporting date, also on the actual date when you authorize for issue, that there's something has happened, now you may not continue for more than 12 months, then also there is a going concern assumption gets challenged. And you may not be able to continue to prepare your financial statement on a going concern basis, so on and so forth. So you got to look at all of this very, very carefully. Interim financial reporting, not much from the perspective is you got to follow a similar set of principles what you follow for preparation of financial statement on an ongoing basis. If you are required to prepare an interim period, means a quarter, half year, or a 9 month, and not a full year, that's an interim period. If you're doing an interim period, then you should follow the principles as outlined under Ind-AS 34, which is to say that follow your accounting policies on a consistent basis, do an appropriate presentation, you can do a condensed P&L, condensed balance sheet, there are less disclosure requirement. The only fundamental change we see in accounting for interim period is around accounting for income taxes, around accounting for income taxes, where you actually try to figure out what is my ETR, effective tax rate, for my total income during the year. Once you determine that this is my ETR and that is the ETR you apply as an income tax expense, you are not in a way required to do a very elaborate accounting of your current tax and deferred tax and those huge number of disclosures which you are required to make in your interim period financial statement. This is the disclosure requirement in an interim period financial statement are far lower than what it is otherwise. Otherwise, from a recognition measurement, same accounting policies shall be made on a year-to-date basis, same recognition principles. Cyclical, occasional, or seasonal revenue shall not be anticipated or deferred as on an interim period, right? So all of that you got to watch out and understand this, right? But it's largely okay. We don't see too many complexities or challenges here, other than in terms of looking at your income tax expense, where you got to determine your effective tax rate and then apply that ETR in a way to your profit before tax, and you also got to adjust the ETR for some discrete item, for example, like foreign exchange gain. You can't predict a foreign exchange gain. So whatever is a foreign exchange gain or loss in that period, if that is taxable, you're going to provide for the tax expense in that period in disregard of that ETR. So adjust the PBT and take out your foreign exchange and then apply your ETR on the balance item and then separate tax expense on your foreign exchange income in a way from that perspective. Moving forward to talk about operating segment, right? What are your operating segments? What are your segments? Segments are nothing but components of business units which are being reviewed by CODM. What is the CODM? CODM is Chief Operating Decision Maker. It could be an individual, it could be a committee, it could be a board, at a level at which decisions are being made in the organization in terms of performance assessment, in terms of allocation of resources, in terms of taking decisions as to what business to continue, not to continue, or evaluation of performance of people who are responsible for that line of business from that perspective. For anything to qualify as a CGU, it has to have a discrete financial information. What is the meaning of a discrete financial information? Meaning of discrete that you should have some P&L, you should have some construct of the balance sheet, but P&L is what is a must. You need to have a P&L for you to determine that what's the performance, and that is what in a way eventually being reviewed. It could be based on geographical spread, it could be based on products, or it could be a combination of a product and a geography, which is what we call as matrix organization. So it all depends upon how you have organized your business, how your chief operating decision maker is doing the reviews. So that is the operating segments, is the ability to earn revenues. Results are reviewed by the CODM and the discrete financial information is available. Once you have an operating segment, you will then identify the reportable segment, and from a report, ordinarily all operating segment could be a reportable segment, but you don't want to report everything. So what you do, you see, do I have operating segments which are similar in terms of the product and services? So you look at the aggregation criteria, say, are the similar nature of products and services, nature of production process is similar, the type and class of customer for their products and services are similar, distribution method is similar. If that been the case, you can aggregate them, and then that in a way becomes your reportable segment. You got to continuously report, identify segment to the extent you got to do at least 75% of total revenue is what you need to identify and disclose. Many company we see has 2, 3, 4, 5. Ordinarily we don't see beyond 5. Most common we see 2 to 3. Rare to see 1, like no segment. Okay, it's not common, but few companies do only have 1 segment. Lot of companies will have 2 to 3 segment. Some may have 4 to 5. Beyond that we don't see in general in practice. And it could be based on geographical spread, say North India, South India, East India, West India, for example, or India or Americas or Europe, or Asia Pacific, etc. Or it could be type of product. So to say, if you are ITC, for example, tobacco products or non-tobacco products, for example, just for an argument's sake. So it could be based on products, could be based on geography, or it could be a mix of the two. All of that is what you need to look at, identify at the level of CODM, Chief Operating Decision Maker. All right. Now we move forward to talk about fair value measurement, right? Now, what is a fair value measurement? This is defined under Ind-AS 113. Fair value is defined as the price which is expected to be received to sell an asset. What is expected to be received to sell an asset, or paid to transfer an obligation in an orderly transaction between market participant at a measurement date, right? Which is called as exit price. Fair value is nothing but exit price. What is exit price? That means I can sell this asset at this price. What is exit price? That means I can transfer this liability at this price to another party. I may or may not do it, right? I may not transfer it, but I can potentially potentially transfer. There's a buyer out there who's willing to take on this liability, and I have to pay so much if I were to transfer this obligation to another party, right? That's the assessment of fair value in an orderly transaction between market participants. Market participants means you have the knowledge of that asset or the liability at a measurement date. That's what the definition of fair value. Fair value, price which is received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at a measurement date, not in between related parties, right? If you're doing a transaction between related parties, that's not an evidence of fair value. Now, then you determine fair value at a unit of account. Let's say building, right? Am I going to determine, when I'm going to determine fair value of this building as the entire building? Or no, there are different floors. The floors can be sold, right? So every floor is a unit of account. Or let's say I have 20 floors, so I'm going to look at them together, or I'm going to look at them each unit. For example, shares. I have 1,000 shares of this company, so I'm going to look at 1,000 as a unit of account. No, I can sell one share each. So one share each is a unit of account. Unit of account is what level you can value that asset or a liability, as the case may be. That's a unit of account. At what level the market participant is supposed to value that asset or the liability. What's the principal market? Market where I have access to, market where I do most of the transaction, which is normally the place in which the asset or liability are being transacted with highest volume, with higher level of activity, with any other market available for similar transaction. Most advantageous market is market where I can maximize my return. So there are two markets, right? I can sell in the wholesale market and a retail market. If I were to sell in a wholesale market, I will get 100. If I were to sell the same thing at the retail market, I will get 120. But for me to sell in the retail market, I have to ship the goods. I have to incur a commission cost. That means my realizable value in the retail market may not be 120, but only 105. From that perspective. So what's the most advantageous market, right? Is where I can maximize, market that maximize amount that would be received. Market participants, which has knowledge of the, which is knowledge of the items or transactions, which are subject matter of valuation. So it provides guidance on how to measure fair value when required or permitted by specific Ind-AS. It in itself does not give you any accounting guidance. It says this is how you need to assess fair value. Now, for you to assess fair value, there are different valuation techniques which are specified, which is to say market approach, income approach, and cost approach. What's a market approach? A P, price into quantity. It's a traded commodity, traded stock, price into quantity. What's an income approach? You follow a discounted cash flow method. That's an income approach. Or you follow a cost approach. What is it will take to build the same asset, like a replacement cost approach? These are three different techniques which are being used. We see most commonly is the market approach or the income approach, which is being followed to determine the fair value, right? Determine the fair value. And then you got to do disclosures of all your determination into three different categories: level 1, level 2, level 3. And level 1 is where the degree of reliability of fair value is the highest, right? Which is the price which is quoted in an active market. So price into quantity, that's the level 1 evidence. Level 2, when actually you're using valuation techniques, where you are actually deriving the fair value based on observable inputs, right? Let's say, I have 1,000 shares. But there is no trading of 1,000 shares in this market. It gets traded in the blocks of 10,000 shares each. So if it is a trading of 10,000 shares, I have got 1,000. What's the fair value of this? I'm trying to derive this based on observable data. That is level 2. Now, level 3 is when I don't have the observable data. I'm trying to determine fair value with reference to valuation techniques like discounted cash flow approach. That's like a Black-Scholes option pricing model. Now, that's a level 3 valuation. So you got to then categorize all your fair value disclosures for a reader to better appreciate as to the quality of your accounting, your degree of confidence in your balance sheet carrying value of assets and liabilities, which are to be accounted for at fair value. So you got to group them into level 1, level 2, and level 3. For level 3, there are more disclosures which are required to be made. So what are the methods of valuation? Income approach, cost approach, and a market approach. What's the fair value? Fair value is the price to be received to sell an asset or paid to transfer an obligation in an orderly transaction between marketplace participant at a measurement date. So you got to again look at how do you determine in use or in exchange, which is called highest and best use, that how possibly I can use this. Either I can generate more benefit by using this, or I can generate more economic benefit by selling this, right? So again, then you figure out what's my principal market, what's my most advantageous market. All of that is what you look at from a Ind-AS 113 perspective. Okay. Now we're going to talk about financial instrument. Financial instrument, very, very important topic, right? Financial instrument. So now, and lot of questions which are coming here, right? 62 marks every time, 16 to 20 marks, right? So important topic for you to go through, understand, and kind of remember, right? So what is a financial asset? What is a financial instrument? Okay, what is a financial instrument? Financial instrument, let's say from an examination perspective, the big focus is on compound instrument. Make sure that you are fully clear on this concept. Okay, what is a compound instrument? A compound instrument means which is a hybrid instrument, which is a construct of both equity and a debt. Okay, that is what is a compound instrument. Look at all number of examples, and get your concepts absolutely clear on compound instrument. More often than not, there is a question on this. Fair value asset is 4 marks, forward contract 8 marks, security deposit 4 marks. Not to worry there. But compound instrument, just be very, very clear in terms of your concept. This is an area which has been highly tested. All right. Now, what is a financial instrument, right? A financial instrument is something which is any contract that give rise to a financial asset of one entity and a financial liability or equity instrument for another entity. So what is a financial instrument? Something which originate out of a contract, not out of a statute. Like income tax payable is not a financial instrument. Sales tax payable is not a financial instrument. Okay, but what is payable? But accounts receivable, right? Accounts payable, cash, security deposit, equity share investments, right? All of the borrowings, capital, all of these are financial instruments. Something which, so when you think through, look at your balance sheet, right? On the right hand side of your balance sheet, you have cash, you have securities, you have investments, right? Then you have property, plant and equipment. Property, plant and equipment is a tangible asset, is not a financial asset. Then you have inventory. Inventory is a non-monetary asset, not a financial asset, right? So something which is not something against which there is no liability of the counterparty or equity is not a financial. Cash, there is a liability of the government of RBI, Central Bank of the country, right? That's why it's a financial asset for me. For you, it's a liability for the central bank. Account receivable, it's an asset for you, it's a liability for somebody else. Equity shares is an equity instrument, right? Security deposit, an asset for you, it's a liability for somebody else. So it's an asset for you and a liability or equity instrument for another enterprise. Something which originate out of a contract, cash, equity shares, right to receive cash, or obligation to pay, right? What is equity? Where there is no contractual obligation. That is why preference shares are not equity instruments. Preference shares are at best are compound instruments. Why? Because in preference shares, there is a redemption obligation you have. If there's a redemption obligation, that means you can't avoid the payment. So that for any instrument to be considered as equity, that means that I have the ability to avoid the repayment. I may decide to do a buyback of share. That doesn't mean that it is a liability, but I have the ability to avoid doing the buyback of share. I am under no contractual obligation whatsoever to do this buyback of share. Okay, it is my voluntary decision, my decision. Okay, now whatever the cost of that decision, that's a separate issue, but it is my decision. Okay, so what is a equity instrument? Where I have under no contractual obligation to pay. Many times you got to look at also a derivative instruments. When are they equity classified derivative instrument? When they are convertible into fixed for fixed. That means fixed number of shares at a fixed amount. You know both the amount and the number. If you know, and the settlement is going to happen in by way of issuance of stock, and if that number is known, the number of shares I'm going to issue and the amount of what I'm going to issue, the price per share also I'm going to issue, that is when it is fixed for fixed criteria, in a way is an equity instrument. Now, what is a compound instrument? Compound instrument. So again you got to look at is that when any instrument, financial instrument, am I carrying the interest rate risk? In a debt instrument, you're supposed to carry the interest rate risk and the credit risk. In an equity instrument, you carry the price risk, as a risk. So you got in a foreign currency, and you carry the currency risk as well, right? So you got to evaluate what is the risk is what I have in this instrument, right? For you to say, is it an asset? Is it a liability? It is an equity. Equity means I'm not going to pay back. I'm under no obligation to pay back to anyone whatsoever, right? If that been the case, then it's equity. What is compound? Compound means it has the component of equity and debt, right? Now, what does this mean? Let's say I've given you, a debt, 100 rupee debt, and I say this is for 5-year period, and I'm not going to charge you any interest. The whole question is, why will I give you this debt, interest-free debt? I'm giving you interest-free debt because we are related parties, right? Because I am your shareholder. That's why I'm giving you this. Or if let's say I'm giving you this debt because I'm your customer, that means I'm giving you this debt as an advance, right? And you got to deal with this. So from which party is also given you this is what you need to look at. So if this is a compound instrument which is a component of both equity and a liability, okay? If it is a compound instrument which is a component of both equity and a liability, you got to split the instrument. You got to split the instrument. And how do you split the instrument? Remember, all financial instrument initial recognition is always at fair value. So if it's a compound instrument, determine the fair value of the debt. Okay, determine the fair value of the obligation, record, and then the residual gets allocated to equity. Residual value gets allocated to equity. Recognize the liability at present value of cash flows, recognize the balance as equity. And that's where you got to be very, very careful. Now, even if you've raised the debentures, right? Let's say I've raised 6% debentures, which are perpetual debentures. That means I'm never ever going to require to pay back these debentures, but I'm required to pay interest on these debentures, right? If I have to pay interest on these debentures, and that also only when I have profits, for example, right? Now and I decide to disclose, I decide to declare, I decide to declare a dividend to my shareholder, then only I need to pay interest on these debentures, for example. Then actually those debentures are also like equity instruments. If there is no redemption obligation, then that in a way is akin to equity. If on a preference share or any instrument, you have to mandatorily pay dividend, even when it's called a dividend, but if I have to mandatorily pay 10% dividend every year, right? That's my construct. Then that is actually a liability. The present value of future obligations of dividend is nothing but a liability. Is that what you need to then record in a way from that perspective? So you got to appropriately determine. My point here to all of you is that this is an area which is often been examined, and you got to make sure that you have full clarity on this in terms of how is a compound instrument. It's an instrument which is a component of both debt and an equity. How do you do accounting here? Determine the fair value of the debt at let's say at the market rate of interest and discount it to the present value. Let's say you received 100, on which you have to pay interest only at 5%. where the market rate of interest is 12%, right? Then this 7% delta, you got to assess who has given this debt to me, right? Is this been given to my supplier, by my customer, or by my shareholder? If a shareholder has given this, then that's nothing but an equity contribution. If a supplier has given this, then of course that goes against the advance, right? If a customer has given that, that's possibly going to get factored in your revenue recognition process. So you got to evaluate this very, very carefully, right? So it's a compound instrument. You got to determine and then measure the liabilities at amortized cost or fair value. Equity instruments are never remeasured, which goes into an equity box, right? Not on the asset side, but on the left-hand side of a balance sheet, whatever goes into your equity box, they are not allowed to be remeasured. How do you do accounting? For your financial assets are of three types: debt, derivative, or equity, right? Debt could be a vanilla debt or a hybrid debt, right? Which is a component of both the debt and an equity risk. So think through what is the type of risk I'm taking from a debt instrument. Am I taking only the interest rate risk and the credit risk? In an equity instrument, you take the price risk. In a derivative instrument, you're taking you got to figure out what's the underlying, what's the variability in that derivative, but there is a variability. So if it is the risk which you are taking in the instrument is, then you got to evaluate how do I do accounting for this. You got to look at a contractual cash flow test or a business model test. What's the contractual cash flow test? Is the contractual cash flow which are going to be generated from this asset are only going to be solely the payment of principal and the interest. If that is the case, you meet the contractual cash flow test criteria. If you fail the contractual cash flow test criteria, the accounting for those financial assets are always at fair value, Now, let's say you met the contractual cash flow test criteria, then you go to the business model test. What's the business model for which this type of financial asset? My business model is to keep it till maturity. I'm going to do accounting for it at amortized cost. My business model is to held for maturity, but I may decide to sell it, right? Then you do accounting at fair value through other comprehensive income. If your business model test is for is for selling and for trading gains, you do fair value through profit and loss account. For all your derivatives, you always do fair value through profit and loss account. For your equity instrument, because they will always fail the contractual cash flow test, you will do it at fair value through profit and loss account. You have an accounting exception where you may designate an equity security at inception that to be recorded at fair value through other comprehensive income. If you have taken that policy choice, then it will always be at fair value through other comprehensive income. It will never be allowed to reclassify it even when realized. When you want to realize that, you can do a balance sheet reclass between your other comprehensive income to retained earning, but you are not allowed to reclass in the statement of income. On the debt side, if you have done a fair value through OCI, then it gets recycled to P&L on realization in a way from that perspective. Or you also have a fair value option of doing an accounting, for example, if it were to eliminate an accounting mismatch, from that perspective. So you think through a financial instrument, I have to look at what is a financial instrument, a contract which results into a financial asset and a financial liability or equity, then financial asset, cash, receivables, securities, investments, all of that. A financial asset, financial liability is my debt, borrowing, payables, all of them are financial liability. Equity is which I don't need to pay to anyone. Then I could have compound instrument which has a characteristics of both the debt and the equity. Then I got to record the debt at the fair value and the equity is the residual amount, and then I do the subsequent accounting for the debt either at amortized cost or fair value. Then I look at the accounting for financial asset. Accounting for financial asset are either at either it is a debt, derivative, or equity. If it is a debt, I'm going to look at a contractual cash flow test, and I'm going to look at a business model test. Contractual cash flow test is the risk of is the attribute, the quality is only solely the payment of the principal and the interest, which is what we call as SPPI test. And then we look at the business model test, that I'm going to keep it till maturity, or I'm going to keep it but I may decide to sell it, or I'm only going to sell it for trading. So depending upon that, you will do fair value accounting or fair value through other comprehensive income, or through your amortized cost accounting. For your equity, it's always through P&L. You can take make a accounting policy choice for doing it from other comprehensive income, then it will always be in other comprehensive income. Then we think about the impairment, right? The impairment guidance for financial instrument, and it is what is now being called as expected credit loss model. So you have receivables. I need to figure out my impairment loss on my receivables. Right now, the impairment loss on receivable, you got to then look at the forecast, the future, factor the present, look at your past historical loss rate, look at the present condition, and forecast the future economic environment. You try to figure out a blend of all three, and then you do expected credit loss. You follow this expected credit loss based on two approach: a general approach or a simplified approach. A general approach is where you're looking at a 12-month expected credit loss, or a simplified approach where you look at a lifetime expected credit loss. For receivables, you generally follow a simplified approach. For other complex receivables in your balance sheet, like from a bank's perspective, they'll follow a general approach and not a lifetime approach in general to determine your expected credit loss. Then you do a hedge accounting, right? For the purpose of hedge accounting, you need to understand the concept of derivative. Derivative is something which changes its value with reference to an underlying. So you have a hedge item, you have a hedge instrument, and you have a risk which you are trying to hedge, right? So hedge item could be a recognized asset or a liability, or a forecasted transaction, or a firm commitment. Hedge instrument could be a derivative financial instrument, or a foreign currency borrowing, or an exposure in your balance sheet. For example, if you're trying to hedge a currency risk, and then what is the risk I'm trying to hedge? I'm trying to hedge an interest rate risk, a currency risk, price risk, or a credit risk, and then you got to match the hedge instrument versus your hedge item, and then you are trying to say that, am I trying to lock myself into future, or I'm trying to unlock myself from future? That will determine that whether it's a cash flow hedge versus a fair value hedge. If it's a fair value hedge, the change in fair value on the hedge item goes to P&L, and the change in fair value of the hedge instrument also goes to P&L. If it is a cash flow hedge, then hedge item gets accounted for in the future period. You do nothing in general. But for the hedge instrument, the change in fair value of the hedge instrument, to the extent it is effective, that goes to other comprehensive income to be recycled to the P&L as and when those hedge items gets recorded in the profit and loss account. So that's how you do accounting for derivative financial instrument, from a financial instrument perspective. So financial instrument, again, needless to say, is a very important standard, and you need to acquire good understanding, more importantly, on compound financial instrument, and then other elements as what I talked about in terms of financial asset, financial liability, impairment, and hedge accounting. And then there are tons of disclosure is what you need to deal with. Moving forward to talk about some of the other areas, like employee benefits, share-based payments, effect of change in foreign exchange rates, and agriculture. So very, very quickly, I think employee benefits, there are two types of anything which is paid by an organization in a way to an employee, in a way gets covered unless specifically excluded, like a share-based payment, right? Accounted for under Ind-AS 102. So employee benefits are of two types: short-term, long-term, right? Short-term, long-term could be termination benefit, and then they are further divided into defined contribution plan or a defined benefit plan. A defined contribution plan is something which is like a provident fund. In our scheme of things, it's a provident fund, is a defined contribution plan where an employer is required to, let's say, contribute 12% of your salary in a way to a pool. And then you are, as an employee, you carry the actuarial risk, you carry the investment risk. As an employer, I am no longer obligated to fund anything beyond 12%. However, on gratuity, that is like a defined benefit plan. As an employer, I continue to carry the actuarial risk, the investment risk, the growth in your salary, the longevity of your employment. All of that will determine how much eventually I'll be required to pay, right? From a defined benefit plan perspective. So defined benefit plans are more complex to value, and that is where we need the help of an actuary to value and determine that what is my obligation in the financial statement. And again, there are tons of disclosure requirements which are out there which we need to deal with. moving forward, in a way to talk about the foreign exchange rates, right? So in the context of Ind-AS 21, two things you need to remember: that what is your functional currency and what is your foreign currency, right? What's my functional currency? Functional currency is the primary economic environment in which your business is operating, right? It's the currency of the economic environment in which your business is operating. Any currency other than your functional currency is a foreign currency, right? Now, how do you determine your economic environment? You determine your economic environment with reference to your primary indicator and secondary indicator. Now, what's a primary indicator? Primary indicator is that in which currency how do you determine your cost price? How do you determine your sales price, right? So how do you determine the cost? Currency that influence the sale price, currency that influence the cost price. That's your primary indicator. Then you look at the secondary indicator, right? In which currency I have raised capital, right? In which currency I do my intercompany transaction, for example, right? So all of that in a way which helps you determine your functional currency. Once you determine the functional currency, you're not supposed to change your functional currency, right? The change in functional currency is supposed to be rare. There has to be a significant change in your business environment for you to conclude that there is a change in functional currency. Now, once you've determined this is my functional currency, then any transaction which you do in foreign currency exposes your P&L to a currency risk, right? And then if it is a monetary item, I need to translate, I need to do a revaluation or a transaction gain or loss for that foreign currency monetary item and record that change through P&L. If it is a non-monetary item, for example, I have invested in shares of Google, which are traded in a US stock exchange. That's a non-monetary foreign currency exposure which I have because they are traded in dollar. My functional currency is rupee. Now, if let's say your accounting policy is that the change in fair value of stock will go to P&L, then the currency change will also go to P&L. But if your policy is that no, I have taken a policy choice that change in fair value of stock will go to other comprehensive income, then the foreign currency change will also go to other comprehensive income. Now, this concept is also relevant to enable you to do a consolidated financial statement. Let's say you have a company in India, you have a company in US, you have a company in UK. So all of them gets then you need to translate them and bring into one presentation currency or a reporting currency, so to say. And then the standard prescribes you the methods of translation. For P&L item, you do an average rate or an actual rate. For balance sheet item, you do a closing rate. For stockholders equity item, you do again an actual rate. And then the difference between all of this is something which is called as currency translation adjustment, which again gets recorded as part of statement of changes in equity as part of your other comprehensive income. If you do all of that, that will help you to look at that will enable you to do consolidated financial statements when you as a company have multiple businesses in different business environment and you have different functional currencies. You got to bring them all together in the form of a common presentation currency for the reader of the financial statement to make sense out of your reported numbers. The currency translation adjustment, which is sitting in OCI, is also allowed or required to be eventually gets transferred to the profit and loss account as and when you dispose that foreign operation. If you don't dispose that foreign operation, then it continues in your in a way other comprehensive income on an ongoing basis. So that's how you look at accounting for foreign currency from that perspective. Very quickly, we're going to look at accounting for share-based payments. Now, what is share-based payment? A share-based payment, is the stock options. Let's say if I'm working for a company and the company, along with giving me salary, they also say I'm going to give you stock options. I'm going to give you 100 shares in this company, right? But you will only get this 100 shares provided you fulfill certain employment conditions. Now, what are my employment conditions? That you've got to be in my employment for 2-year period. If you will be in my employment for 2-year period, you are not only entitled for your salary, but you're also entitled for certain stock options. Now, stock options are a form of benefit which a company is giving to the employee, and hence you are also required to determine the fair value of this and record the related cost. Now, how do you determine fair value? You again you follow option pricing model. You follow an option pricing model. It could be a equity settled stock option. It could be a cash settled. It could be a share-based payment transaction with cash alternative. It could be a group share-based payment arrangement that the holding company has given stock arrangement to my subsidiary company in a way. From that, then also you are required to record costs, right? So in whichever scenario, if your employees are getting benefited and that arrangement between you and your employee is of employer and an employee, you are supposed to record costs. Now let's say if you've given if you have given shares to your vendors, right, in that case also you are supposed to fair value what you've received, and then record the value of the shares which you have issued to your vendors. So the simple point is that stocks is a type of a currency which has a value, and if you're using stock for the purpose of shares, for the purpose of your business objective, you got to determine what's the cost of that and appropriately account for it. Now when you do a stock option accounting, there's several things which you need to keep in mind, which is a grant date, vesting date, and exercise date. The grant date is the date when the employer and employee are clear on the terms and conditions of the grant. Vesting date is on the date on which the employee has fulfilled all the conditions which are laid out as part of the grant. Exercise date is the date on which the employee has actually submitted the exercise price, and in exchange he's got allotment of the stock. Now accounting starts from the grant date and accounting stops at the vesting date. Whatever the cost of the stock option, you got to determine at the grant date and continue to account for them till the vesting date, and then depending upon whether it's an equity settled grant or a cash settled grant, you will either freeze the cost. If it is an equity settled grant, you determine the cost at the inception and freeze the cost at the beginning, and then you appropriately amortize that cost over the vesting period. If it is a liability settled cash settled grant, then there's more complex, and every measurement date you got to true up that liability and then keep on adjusting the accounting charge on a go forward basis. And then you can see vesting conditions which are either linked to employment or linked to performance. If it is linked to employment, again it is easy to account for. You account for the cost over the vesting period linked to the pattern of vesting, right? If it is a bullet vesting, amortize over straight line basis. If it is a what we called as accelerated vesting, that 100 you will receive every month, over a 12-month period, then you also accelerate the recognition cost. And again, all of this is specified from an accounting standard perspective. But at a high level, when you receive stock options, you got to fair value. And how do you determine the cost of stock options? You follow an option pricing model. Which are a binomial model or a Black-Scholes pricing model, which has several inputs which goes into that option pricing model for you to determine the fair value of the option, and then that the fair value of the option in a way becomes the multiplied with the total number of options which you've granted, which are likely to vest. And then that is what you account for over the vesting period. Every option has a value, okay? Every option has a value which is greater than 0. Always remember, every option has a value which is greater than 0, because the very fact that it's an option, it's not an obligation in the hand of the recipient. Because it's an option in the hand of the recipient, it has some value, and you need to figure out the fair value using an option pricing model, and hence it is not fair value. It's an option pricing model, and then account for it appropriately. All right. Moving forward quickly to talk about agriculture, right? I think it's a small topic. If you have certain agriculture activity, biological assets, and all of that, that's where you do accounting. You can do accounting for this at fair value, less estimated point of sale cost, and then if you're doing accounting for this under Ind-AS 41, then the government grant, you got to be very, very careful, right? There is some interplay. Then the government, if you receive any government incentive in relation to, let's say, your biological asset, then the government grant you only record when you fulfill all the conditions, right? And the receipt of the grant has been established. Whereas in otherwise, under Ind-AS 20, we saw that you can continue to record revenue or that government grant if there's a reasonable assurance that you will continue to fulfill all the conditions. So I think there was a trick question in the exam which talks about this in terms of Ind-AS 41 versus Ind-AS 20. So if it is you're accounting for it under Ind-AS 41, the government grant accounting slightly changed. And hence you got to be careful. And then initial accounting is at fair value. If there's no reliable fair value, then you at costless accumulated depreciation, and cost to sell includes your brokerage, levies by regulatory agencies, etc. So it's fairly simple standard, which is like if you are into agriculture and things like that, that's where we again we don't see a lot of application of this in practice. And again, I don't see too much of impact from an examination perspective. Now let's talk about the last section. I'm going to take another 15 minutes of your time in a way to talk to you about business combination and consolidation and joint venture. Okay, so what's a business combination? All right, a business combination is and again, this is a very important topic, right? I'm sure you must have noticed, right? Every time there's a 25 to 20 marks which is coming. So if you finish this, if you do financial instrument, if you do property, plant and equipment, you're largely done 60% of the syllabus, right? So when you think about the business combination, what are we trying to do here? When you look at a business combination, that there has to be a business and then there has to be a transfer of control. Now, what's the meaning of a business? For you to establish that there is a business, there has to be an input, processes, and capability to generate output. For a business, it has to have an input, processes, and capability to generate output. And what are the inputs? Inputs are raw materials, employees, the whole jing bang. What for which you are running this business. So to say, processes are strategic management processes, which in a way apply to that as input, in a way then help you to generate the output. So output is not required to be necessarily present when you are doing a business combination. Important thing is output has to be capable of being in a way generated. Output has to be capable of being generated. So there is a business and then there is a transfer of control. Now, how do I do accounting for a business combination? Accounting for business combination, in a way, it's a 4-step approach. First is identify the acquirer. The second is determine the acquisition date. The third is determine your purchase consideration, and then determine your goodwill or bargain purchase, in a way. So when I say identify the acquirer, who is buying whom? Many times we see it's 95% of the time this is very clear as to who is buying whom. But then some situation we see that we don't know who is the legal acquirer, who is the accounting acquirer. Accounting acquirer is somebody who is taking control, over the other enterprise. Now, what is the meaning of control? Control means I have the ability to direct all the relevant activities of the acquired enterprise. And we're going to talk about very quickly, the definition of control under Ind-AS 110, right? So I have acquired control. So who is the acquirer? Who is buying whom? So if I'm paying cash, I'm the acquirer. If my shareholders are going to be now the majority shareholder of the combined enterprise, that means I am the acquirer, right? So identify the acquirer, then determine the date of acquisition. What's the date of acquisition? Date of acquisition is not the announcement date, okay? Date of acquisition is that when you have fulfilled all conditions which are specified in that acquisition contract, right? Many a times we also have to go through the court process. So date of acquisition often also is the date on which the court has given the approval. So date of acquisition is not the date which is written in the contract. Date of acquisition is the date when you have fulfilled all the conditions which are prescribed in the contract, which often coincides when you have actually exchanged the consideration. All right, it's a date when you have actually paid out the consideration. Because I said the date of acquisition is 1st January means nothing, right? If you are only going to actually discharge the consideration on 1st of July, right? Why? Because there are several approvals you need to take of several regulatory agencies. Only on the payment there's one more complexity to say that if, let's say, you've actually done a structured payment arrangement to say that I'm going to pay you 100 now and 50 later. That means there's a structured payment arrangement that the 50 in a way then discounted to the present value, and the date of acquisition may be 1st January in that case, provided you've acquired control on that date. Control is acquired. Control is acquired as a result of the acquisition or a business combination. All right. Then the step three is your purchase consideration. For the purpose of doing this business combination, how much I am paying and in exchange what all I am receiving, right? How much I am paying and in exchange what all I am receiving. So how much I'm paying cash, I'm paying securities, I'm kind of taking on some more liabilities. So that all of that is your contract consideration or a purchase consideration. Remember, legal cost, due diligence cost, all cost, external cost, which is not going to the seller. Okay, all of these costs which you incur, or a issue raise, debt issue cost, or a equity raise cost, all of these are charged to P&L or to other appropriate item. Like if it is equity raise cost, goes to equity capital, right? If it is a debt issue cost, gets factored in your effective interest rate. If it is a legal consultant cost or an advisor cost, all of these are charged to P&L as a period cost. They are no longer allowed to be capitalized. Okay, so deal cost is no longer allowed to be capitalized unless an equity cost goes to equity box. If the debt cost gets factored in your EIR computation. Okay, so how much I am paying for this acquisition to the seller, in exchange now what is it I am receiving? All fair value of asset and liabilities. Fair value of all assets, when I say assets, are tangible assets and intangible assets. Okay, tangible assets and intangible asset. Intangible like copyright, trademark, patents, brand, right? All of these, non-compete, customer contract, distribution right, so on and so forth. So I got to look at all intangible assets which are in multiple category, like artistic related, marketing related, technology related, customer related. All of these intangible assets I need to identify, which I may have acquired in this business combination. What are the other tangible assets? What is the land? What is the fair value of each of them? I have to get all the fair value. Then I need to see what are liabilities I have taken over. What are liabilities I have taken over? What is the net of? Is there any non-controlling interest which is there in this? All of that I need to look at, compare it with my purchase consideration. The residual value is nothing but sum total of unidentifiable intangible assets, which are then subsumed and recorded as goodwill. That the balancing number is goodwill. For the purpose of non-controlling interest, you have an accounting policy choice, which you can do either at a fair value basis or at a proportion of net asset cost basis on an acquisition by acquisition. All of that is what you do. If there's a bargain purchase that you paid, let's say 100, and the net fair value of the asset which you acquired is 120, then the excess which you receive doesn't go to your P&L, that goes to other comprehensive income. That goes to other comprehensive income under Ind-AS 103. Now we have done the business combination. Now I need to assess how do I go about the process of consolidation. So now consolidation means, do I have the power and the power to direct the relevant activities, which results into an exposure from a variable return perspective. So I have the power to direct. So when you look at a consolidation and the control, you got to identify what are the relevant activities of this business enterprise. Do I have the power to direct all the relevant activities for that business enterprise so as to impact, which results into variability in my return, right, of my exposure with that entity? More often than not, if you have more than 50% stake in any business, it is presumed, unless rebutted otherwise, that you have control, right? You can also have control at less than 50%, which is what we call as de facto control. You can also have de facto control by having 40%, because rest of the shareholding is so distributed. Nobody comes to the annual general meeting. Nobody comes to any decision making. I have the ability to control the entire board. I actually appoint the whole of the board. So it means it's a de facto control. But we generally don't allow companies to start consolidating based on de facto control. So you ordinarily consolidate when you have control, which is power to direct, and control. As control, you need to in a way, you don't need to exercise control, so to say. Okay, you should be able to demonstrate control, that I have control. Now if I have control, you are supposed to then consolidate that business enterprise. That means you need to mandatorily prepare consolidated financial statement. When you have to prepare consolidated financial statement, means what? that you have to do intercompany elimination, right? You have to compute any non-controlling interest. If you have any, you got to follow uniform accounting policies. You got to combine assets and liabilities on a line by line basis, go through the whole process of consolidation, and more often than not, they also test you by way of asking you to do this prepare this consolidated financial statement. So key thing, if there's an intercompany transaction, you got to eliminate them, right? If there's a non-controlling interest, you got to compute them and record it. From that perspective, the complexity come sometimes, in relation to taxes on intercompany transaction. There's an inventory from A to B, and it is still in inventory. You will eliminate the inventory. You also got to eliminate the income tax expense. Okay, remember to set up a deferred tax cost, deferred tax on the intercompany inventory as well. If it is still there and there is an unrealized profit which has been sitting and there was a tax expense which was paid, look at that concept. That's an important concept. Now, if it is not a subsidiary but you have a significant influence, there also you do consolidated financial statement, but instead of doing a line by line consolidation, you do a single line consolidation. The outcome is the same, but instead of doing line by line revenue, asset, expenses, taxes, you don't do all of that. You do a simple pickup of profit and loss. You do a pickup of their OCI item, and then you compare that with the carrying value of the investment, add it to that. If any dividend you receive, you reduce it in a way from your carrying value of investment, because you are doing an equity pickup. So Ind-AS in a way 20 is a one line consolidation, is a single line consolidation, whereas Ind-AS 110 is a line by line consolidation. Similarly, when you do Ind-AS 111, joint arrangements are of two types, which is a joint operation or a joint venture, right? Now, what is the meaning of a joint operation? That means that what is the first of all joint arrangements, where the two parties, three parties, four parties coming together, and all of them have to decide together. They have to decide together, jointly control. So the decision has to be together in relation to all the relevant activities of the business enterprise. That's a joint arrangement. So a joint operation or a joint venture. If it is a joint venture, you do accounting like an equity method accounting. Under existing Indian GAAP, we wish to do proportionate consolidation. That is done away with. No longer proportionate consolidation is allowed. So you will only do equity method accounting for joint ventures, and many more often than not, if you're doing it like a corporate structure, you will end up concluding that this joint arrangement is a joint venture, and I will do an equity method accounting, which is a single line consolidation. However, if it is a joint operation, then like a jointly controlled asset, for example, then you will account for your respective asset and liabilities and determine. The accounting is slightly complex for joint operations, and you got to be careful, follow on the facts, and then look at the presentation, how much revenue you get, how much asset you get, how much profit you get. All of that you got to carefully evaluate in a joint operation, where it's much simpler in a joint venture accounting. So in a way, to summarize, to talk about what all we've done, very, very extensive session. Thank you very much for being with me for last 3 hours in a way. So all the different element of the standard, whether it is asset, liabilities, revenues, financial instruments, or a group financial statements, or other accounting topics, all of them are relevant. The big focus area should be on your consolidation, on your business combination, then on your financial instrument, then on the compound instrument. Don't forget to understand those concepts. Then on property, plant and equipment, on depreciations, on revaluation, those type of principles. All of that is what I'm hoping that this is giving you a good perspective, and will help you as you go back and keep on doing revision. You'll be able to relate to what you heard today, in terms of your preparation, and all the best. So I think we're done here. So thank you very much.
Thank you so much. Yeah, thank you so much, Sandeep. This was a very, very, must be very heavy session for you as well. But an amazing marathon session. Thank you so much for this. Thank you everyone for joining us. All the best for exams. Do share your results with us when you score, highest in Ind-AS and financial reporting. and we'll share the link with all of you of this webinar as well when we'll upload it on it. Thank you, Sandeep. Thank you, everyone.